Good evening, everyone. Good evening. Good evening. Good evening. Good evening.
Good evening, sir.
Good evening, Shreya.
Good evening, sir.
Good evening, Shiva. Let's wait for others also. I hope everyone have received the notes. Let me share the notes in the group, the revision group once again. Yes, it will be uploaded on the YouTube channel. I'll share the link in the group. The link will be shared in the group.
Good evening, sir.
Good evening, Rifa.
गुड इवनिंग सर।
गुड इवनिंग मनन सर। कैसे चल रहा है मनन?
अभी डर लग रहा है सर।
डर लग रहा है रे?
सर
कोई
पहली
नहीं।
बार पेपर दे रहा।
अरे पेपर ही तो है रे। जस्ट अ पेपर. हाँ. It
यस
will
सर।
not decide your future, नहीं ना.
सर घर वाले नहीं समझते ना ऐसा।
कोई नहीं. You have done your hard work.
यस
Everything.
सर।
चलो चलो चलो. Good evening, everyone. If you have joined in, good evening, good evening. Many have joined the group, but Raj sir, good evening. Others, good evening. Let's wait for 5 to 10 minutes. Others also can join. You can share the link with your friends also if they want to join, or in any group or in any Telegram group if you want. You can share them so that they can also join. Chalo, 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 chalo. Good evening, everyone. So let's start with the revision for FR. The revision will continue for 3 days, Friday, Saturday, Sunday. evening 6 to 9, 9:30. It can extend half an hour or 40 minutes depending upon the speed or the pace. So the agenda of this revision marathon is what to cover the entire syllabus in 10 to 12 hours. In this, what we will be doing, we'll be revising the standards, the common mistake which you should avoid that, and the MCQ question which can be tested. In each and every topic, I'll be saying which are the MCQ questions that can be tested. In our regular classes, I have already mentioned, okay, in this topic, this can be tested, etc. Here again, once I'll repeat those. So now, so before that, I hope everyone are giving the exam in September, the next week. I hope everyone is familiar with the new format of the PNL. The new format of the PNL is clear to everyone. I'll revise it before starting the standards. 5 to 10 minutes I'll revise that, and after that we will jump to the standards. So now coming to the financial reporting table. It's for 100 marks. Everyone knows the pattern. Section A, Section B, Section C. Section A 30 marks, Section B 30 marks, Section C 40 marks in total. Section A, Section B, any area can be tested, but I will say Section B, which area will be tested. Let us discuss. Then in Section C you have consolidation, final account, that is your single entity, and interpretation of financial statement. For sure, an interpretation question will be there in your exam, and it will be easy. Believe me, it is easy. Then in Section A, we have 15 questions, 2 marks each, 30 marks in total. Section B, 3 case studies we have. Each case study will have 5 MCQ of 2 marks to 10 marks, total 30 marks. Section C, question 1 will either be from your consolidation or single entity. Then question number 2 will be from interpretation, and in interpretation 4 to 6 marks will be straightforward for ratio calculation. Avoid silly mistake in this area. Then coming to the syllabus part, I have the syllabus of FR. I have divided into 5 parts. So part 1, part 2, part 3, part 4, part 5. In part 1 you have the standards as IAS 16, IAS 20, 23, 36, 48, 40, IFRS 5 and IFRS 18, the new standard, which has replaced IAS 1. Then in part 2, you have your IFRS 15 revenue, IFRS 16 leases, then you have your financial instrument, then you have your EPS, then you have your deferred tax, income tax. Then in part 3, you have small standards. In part 3, you have small standards. Then coming to part 4. Part 4 is of groups consolidation totally. And part 5 is what? Cash flow, interpretation, and the theory part, conceptual and regulatory framework. Now see, this part 1 in your exam will be tested for 25 to 30 marks. It can come in Section A, Section B, Section C. Part 2 can be tested for 35 marks to 40 on an average. This will be tested in what? Tested in Section C and Section B. Out of these 5 topics, that is revenue, leases, financial instrument, EPS, deferred tax. Out of this 5, the question 2 Section B question will be from this topic on. Most of the time, 99.99%, it will be revenue, lease, financial instrument, EPS. Deferred tax, they will not ask. Then in part 3 also varies from 20 to 25 marks in your exam. This part 3 is tested in your Section A. Section A, all small standards theory question. Then part 4, consolidation, 2 MCQ consolidation, 2 MCQ from consolidation will be in your Section A. And part 5, your cash flow. If full question will not come in cash flow for FR, then in interpretation Section C question will come, as well as in Section A question will be that 2 marks. And conceptual and regulatory framework, 2 to 4 marks question can come in your Section A. For sure, you'll have question regarding interpretation, conceptual framework, and consolidation in your Section A. 5 questions will be there, 5 to 6 questions. Other than this, from your part 3 also, like IAS 2 inventory, IAS 10, IAS 8, IAS 21, IAS 37, IFRS 13. So now, this is the way I have divided the syllabus. So the agenda will be what today? To do the part 1, revision of part 1, and in part 2, we will cover IAS 2 and IAS 41. Tomorrow, the agenda will be to discuss part 2 and the remaining standard, and at the last day, the third day, part 4 consolidation and interpretation and conceptual and regulatory framework theory. So I hope to everyone this is clear. Now, how to pass the exam FR. You have done your preparation as of now. Everything is done, sir. We have written mocks, we have evaluated, we have done a lot of MCQ. But if let me discuss this so that you'll get to know, okay, FR is easy and it's easy to pass. In section A, you'll have 15 questions. Out of 15 questions, 8 to 9 questions will be easy. Avoid silly mistake in these questions. Read question carefully. Avoid silly calculation mistake. What is important? Part 1, 3 and 5, very important. Theory question, use what? Elimination technique. You have to use what? The elimination technique. Out of 4 sentences, eliminate 2, then decide out of the 2 which one is the answer. Then in section B, 3 case scenario, each case 5 questions. I mentioned here 6 to 8 questions will be practical, 8 to 8 to 9 can be theory questions. That means if 5 questions are that 2 practical, 3 theory, or 3 practical, 2 theory. So aim should be what? Aim should be that 9 to 10 questions should be correct. So the accuracy should be more than 60%. And which part is important? Part 2 and part 3. As well as part 1 also, but part 2, part 3 and part 1. Theory question, use elimination technique. Then coming to section C. In section C, question number 1 will be regarding consolidation single entity. Believe me, 12 to 14 marks will be straightforward, easy. Avoid silly mistake in this. Then coming to your question 2, sir, interpretation. Many students will face issue in this. At the third day, we'll discuss what is the trick to tackle with this, the interpretation, and 6 to 7 marks will be based on ratio calculation. Do not do mistake in the ratio calculation. So interpretation can come from 12 to 15 marks. So out of this 12 to 15 marks, easy 8 to 9 marks will be there. Whatever is written in the scenario, link to the ratio, write down, you'll get marks. So I hope everyone, it's clear what is the hack to pass FR. Now, chalo, what is important? All this you've already covered. So now see here, 58 to 62 marks will be easy or manageable. 20 marks will need careful reading. That means what? It will be little bit twisted. You have to focus on reading the question properly. Then 8 to 20 marks will test deep application. It could be theory also, it could be regarding standards also. But the deep testing or the deep knowledge which will be tested will be easy. Now, chalo, let us start with today's session. We will discuss IAS 16, IAS 38, IAS 40, 20, 23, IAS 36, IFRS 5, IAS 2, and IAS 41. Till here, is this clear to everyone? Can I start with the revision of the standards now?
Yes, sir.
Yes, okay, chalo then. Let's start the discussion with IAS 16. Sir, is the standard important? Yes, it's very important from the MCQ point of view, as well as 5 to 6 areas are there which are very important for FR. So I hope everyone knows what is the definition of asset. Asset is what's a present economic resource controlled by an entity as a result of past event. What is the past event? We could have purchased a building. When we have purchased a transaction is that is the past event. An economic resource means what? An economic resource means a right that has the potential to produce economic benefit. It's not compulsory that you should have ownership. MCQ question. Is it compulsory to have ownership? No. It is compulsory that you should have a right. You should have a right to get the economic benefits. So under asset we have what's a non-current asset, current asset. So non-current asset means what's a benefit is for more than 12 months. Current asset benefit is less than 12 months. Under non-current asset, further classification of tangible and intangible we have. Tangible means we can touch, intangible we can't touch. So for tangible, we'll follow which standard? IAS 16, that is property, plant and equipment, and IAS 40, investment property. For intangible asset, it is what? IAS 38, intangible assets. Now, coming to the first thing, we will go with meaning, recognition, measurement, presentation, disclosure, derecognition. So first, what is the meaning of PP? So PP is what? So PP is a tangible asset, and it is expected to be used for more than one period, that is more than 12 months, and it is held for either it is used in the production or supply of goods or service, or it is given to rental to others. It should not include land and building or administrative purpose. That means the company is using, it could be a warehouse, or the company is using this building for office purposes. So PP is what's a tangible item held for use in production or supply of goods or service. Rental to others, it should be other than land and building. Other than land and building, any asset you give on rent will be under IAS 16 or administrative purpose. So now see, for land and building, we have seen IAS 16. When will you say that the land and building will be IAS 16? You will say that land and building will fall under IAS 16 when it's used for administrative purpose, like a warehouse, like a office building, or it is used in production or supply of goods or service. If I say today I have a building, this building I have given on rent, normally you say IAS 40. But if I say my business is of what? Purchasing building and giving on rent, purchasing building, giving it on rent, in that case we say it is what? IAS 16. IAS 40 what? Rental to others, and it should not be your main business activity. It should not be a main business activity or capital appreciation or both, or if any use is not determined. Again, we will discuss this once we come to IAS 40. So see now some examples I've written. Land and building held for use. It is IAS 16, sir. Land and building held for sale in ordinary course of business. It's IAS 2 inventory. If I say land and building held for sale, your IFRS 5 non-current asset held for sale. Now land and building for rent. Business is of giving land or building on rent. IAS 16. Business is not of giving land and building on rent. IAS 40. Now then, any asset other than land and building is given on rent. IAS 16 PP. Then office building, factory building, company quarters, building for staff accommodation. If the company has purchased any building and the staffs, and this building is given for the accommodation of staff, it will come under IAS 16 only. Even though the employees are paying what the normal market rent, it will still be IAS 16. This can come in your MCQ question. Then recognition, done with the meaning. Now coming to recognition. Recognition, when we will recognize an asset will be recognized, that is your PP. When, sir, probable future economic benefit is there and cost can be measured reliably. That means we should know the cost. To record, we should know the cost. Then recognition principle, if it is satisfied, we will record as a PP in the non-current asset head in the balance sheet. If it's not satisfied, we will record this as an expense in the P&L. Which category? Operating category. Which category? Operating category. Your IFRS 18 has three categories: operating, financing, investing. This will go to operating category. Then coming to the measurement principle. Measurement means at what value we will be recording it. Initially, PP will be recorded at cost. Initial cost and subsequent cost we will see. Then subsequent measurement at each reporting date, at each balance sheet date, it will be recorded at cost model or revaluation model. This is what accounting policy. The company has a choice. Either the company can use cost model, either the company can use revaluation model. Now the question which comes in your exam: calculate the cost of an asset. So see now, initial measurement, an item of PP that qualifies for recognition shall be measured at its cost. Now sir, what is the meaning of cost? See here now. Cost includes any directly attributable cost necessary to bring PP to the location and condition required for it to be capable of operating in the manner intended by the management. Whatever the management says, if the management says that the property should be in a working condition, until the property or the asset is in a working condition, what all cost is there, you will capitalize it. You will not record this as an expense, you will capitalize it. Then we do depreciation and it will be recorded as an expense. So see now, cost. What will cost include? First thing, cost will include what's the purchase price of the PP. What is the first thing? Purchase price of the PP. Then you will add what? Non-refundable cost or import duties. So whenever any import duty is there or any taxes are there, if it's non-refundable, then only we will include. If it's refundable, we will not include in the cost. Then finance cost. Will the finance cost be included? Yes. If IAS 23 conditions are being met, it should be a qualifying asset. Then any legal fees, sir, to purchase the asset, we have incurred some legal fees, we will add it. Initial delivery cost, you will add it. Installation and assembling cost, you will add it. Any stamp duty cost, you will add it. Now, these are the costs which are mentioned. First 6 costs are regarding the purchase of an asset. If you are constructing an asset in-house, in that case, what should we do? In that case, if a building is constructed for the business purpose, site preparation, to prepare the building, first we have to prepare the site preparation cost will be added. Any architect fees or professional fees you're paying, that also will be added. Any employment cost of construction workers, that means employees are working, they are constructing the building, you're paying salary, that also will be added. Then direct material, labor, overhead, etc. will be included. Coming to the next point, testing cost will also be included. This is the area where you have to avoid mistake. What is the first area? This is the first area. This is the second area. You have to be careful. Testing cost will be capitalized, but the income which you get from testing will be recorded as a income or a revenue. You will not reduce the amount. If the testing cost is today, I'd say 10,000, and you're getting a revenue out of this of 8,000, you can't say that, sir, our cost is 2,000. No, no. You will capitalize full 10,000. This 8,000 will be taken as a revenue or other income. Then present value of dismantling cost, which is the favorite topic of the exam in F7. That means what? After 10 years, sir, we have to dismantle the property or dismantle the asset. After 10 years, we are incurring some cost. So what we will do? We will discount that using a discount rate, and we will record that it was. We will record it as a provision, and we will record in the value of the asset. Then any other directly attributable cost also will add. Insurance on transit also you will add. Less trade discount. The second area, the third area where you should concentrate is trade discount. Trade discount you will reduce. You will not reduce cash discount. Understand that. So cost of the PP you will get. Then what are the costs which are excluded? Like your staff training cost is excluded. Administrative and general overheads is excluded. Administrative advertisement cost is excluded. Cost of opening a new facility or inauguration cost is excluded. Day-to-day repair costs are excluded. Selling and allocated overheads are excluded. Initial operating loss, abnormal loss, purchase of any maintenance, all are excluded. This will not be included in the cost of the asset. It will be taken where? It will be taken to the P&L under operating category as an expense. Then some important notes. See now, sale proceed during testing process are not reduced from testing costs but are recorded as a revenue in P&L. Cash discount will not be reduced. Only settlement discount. Cash discount will not be considered. Trade discount you will consider. Any expense incurred or any income earned during the construction. If you're constructing your PP, yes, this will be available. Any expense which is incurred and any income which you get once or during the construction phase. If I'm constructing a property and I have some space, from that space I'm getting some parking money, or I'm giving this on parking purpose, so I'm getting some fees. In that case, that will be recorded as an income. It will not be related to what? The cost of the asset. Then any subsequent expenditure, can you capitalize the subsequent expenditure? Yes, you can capitalize the subsequent expenditure if it enhances the economic benefit provided by the asset. Like it will extend the useful life, it will increase the production capacity of the asset, or it is decrease the operating cost. If anyone is mentioned in the question, please do capitalize the cost in the cost of the asset. So subsequent expenditure, if it's a capital expenditure, sir, we'll capitalize because the revenue or the benefit will increase. If it's a revenue expenditure, it will go to operating category straightforward. Then coming to cost of dismantling and restoration cost. So what we do, it is a obligation, legal or constructive as per law. So what we'll do initially, debit asset credit provision. This provision will be recorded under non-current liability. This will be added to the asset value. Then each year what we will do, each year we will unwind it. So debit finance cost, credit provision for dismantling. This finance cost will be recorded in the financing category, So what is the journal entry on the day one when we purchase the asset? Debit PP, credit bank or payable, credit provision. For dismantling, you unwind the discount and you transfer this to P&L. Then for depreciation, what is the entry? Debit depreciation, credit accumulated depreciation. So this depreciation, where will you record? This depreciation will be recorded in operating category. We are learning the depreciation for IAS 16. For IAS 14, it will go to investing category. Here it is an operating category. So this is the amortization table which we normally prepare: opening, interest, actual payment, closing. Then what is the formula? Discount factor is what? 1 divided by 1 plus r to the power of n. You'll get the discount. Then coming to the next topic known as exchange of asset. Okay, whenever we purchase any asset by exchanging it, in that case, what should we do? What will be the value of the asset? So you have to see two things. Exchange has a commercial transaction. Exchange has non-commercial transaction, a non-commercial substance. Now what does commercial substance means? It will affect your cash flow because you're changing the exchange, you're exchanging the asset. This exchange of the asset will affect your future cash flow. That means commercial substance is there. If commercial substance is there, in that case, what should we do? PP acquired will be recognized at what? First, you will see the fair value of the asset given. Whatever is the asset you have given, you will consider that fair value. If this fair value is not available, then the second one will be fair value of the asset received. If I say today I exchange a machine 1, this is machine 1, machine 2. I exchange this. In that case, machine 1 is going out, machine 2 is coming in. In that case, this machine 2 which is coming in, at what value I will record? If this transaction has a commercial substance, then the machine 2 which I will get, I will record this at what? Fair value of the asset given. That is what machine 1 is given. Whatever is the fair value of the machine 1 will become the cost of machine 2. If the fair value of machine 1 is not available, then fair value of the machine received you will record. If that is also not available, then what we do? Carrying amount of the asset given, you will consider that. If any cash is paid, you will add it. If any cash is received, you will reduce it. If there is no commercial substance, that means because of this exchange, yes, because of this exchange, there is an exchange of asset. In this case, commercial substance is not there. In that case, what will happen? This machine which you're getting will be recorded at the carrying amount of the asset given. Carrying amount of the asset given. So what is the hint to remember? GRG. Given, received, carrying amount of the asset given. This is fair value. This is fair value. So I hope this is clear to everyone. So what is the journal entry we record here? Sir, credit the PP that is going out, debit the PP that is coming in. You will follow the above method. You will see whether commercial substance is there or not. After this, if debit cash, if it is received, if paid credit, and the balancing figure will be the gain or loss. If it's on the debit side, you have a loss. If it's on the credit side, you have a gain. This will be recorded in the operating category as a gain or loss. I hope to everyone the exchange of asset is clear, the definition is clear, the recognition part is clear. Now coming to the depreciation of PPE. So depreciation is what? So depreciation is the systematic allocation of depreciable amount of an asset over its useful life. That means today if my value of the asset is what 10,000, I will depreciate this because of matching principle. We are getting the revenue, we record the expense. So what is the maximum depreciation we can record? That is what depreciable amount. So what does depreciable amount means? Your depreciable amount means what? Depreciable amount means cost of the asset less any residual value. So if I say today my value of the asset is 10,000, but I will receive residual value of 1,000. That means my ultimate cost is how much? 9,000. My ultimate cost is 9,000. This 9,000 is what? This 9,000 is your depreciable amount. Is your depreciable amount. Now, when should you start depreciation, sir? Depreciation on the PP will start when the asset is available for use. That means it is available for use. It can be operated. The next one, depreciation on PP will cease when will the company stop charging the depreciation? Once the asset has been sold or the asset has been classified as held for sale. If the asset has been classified as held for sale or the asset has been sold, in that case the company will stop depreciation. Now depreciation is charged to P&L under operating category for IAS 16. For IAS 40 it is investing category. So what are the three methods for depreciation? The first one is SLM, straight line method, a very easy, cost minus residual value divided by useful life. Then you have reducing balance method, WDV. You take what? Opening carrying amount into depreciation rate. Then you have units of production method of hourly basis. In this case, what will you do? If today a asset is there, the company will say this is the value of the asset. This asset can be used for 1,000 hours. Now this asset can only be used maximum for 1,000 hours. In the first year, if the company has used for 200 hours, what will be the depreciation? 10,000 into 200 divided by 1,000. This will be the depreciation for the first year. If for the second year the company is saying that they are using for 500, then the next year depreciation will be what? 10,000 into 500 divided by 1,000. So I hope this is clear to everyone. The methods SLM, WDV. In case of WDV, the maximum depreciation that can be charged is what? Depreciable amount. So when you charge the depreciation, you should stop once the depreciable amount is reached. This is the area where students will make mistakes. So let me Let me show you a question so that you'll avoid mistake in your exam. So see here now, in case of WDV, what we do, this is the example we had taken in the class. So I say the exchange, the percentage is what, 50. So first year, how much is the depreciation? First year depreciation is 10,000 into 50 percentage. 5,000 will be recorded in P&L. Then next year, closing balance is 5,000. So next year, 5,000 into 50%, 2,500. So carrying amount will be 2,500. Third year, 2,500 into 50 percentage, 1,250. Understand this. Now this 1,250, if I say at the year end the value is how much, 2,500 into 50 percentage, 1,250. So the carrying amount is how much, 1,250 remain. But now I say the residual value was 2,000. If the residual value is 2,000, will you be able to charge the depreciation of 1,250? No. The maximum depreciation which you can charge is how much, 500 only. So you have to see, because the maximum depreciable amount is what, 10,000 minus 2,000, that is 8,000 is the maximum depreciation you can charge. So avoid this mistake in your MCQ question. The next one, then depreciation on land and building. Will we depreciate land? No, we will not depreciate land because the useful life is not determined. Building, we will depreciate it. Then the method of depreciation. If I say the depreciation method is changed, can I say the change in depreciation method is a change in estimate? If it's a change in estimate, then what should we do? We should do prospective treatment. That means from today only, we should consider the change. So see here now, what is the formula you will be using? Revised depreciation will be what? So carrying amount on the date of change minus revised residual value divided by revised useful life. An important question that comes in section A as well as in section B. So what is this? Let me take an example here. So if today I say my value of the asset is 10,000 and the useful life is 5 years. So how much is the depreciation? 2,000. 2,000. Now my carrying amount of the asset is how much? 6,000 here. Now the company is saying that the useful life is not 5 years. The useful life, the remaining useful life of the asset is 7 years. So the total useful life is 7, but you have considered 5. So out of 7, can I say 2 years are done? So now remaining further 5 years are there. In that case, what we do? This carrying amount you will consider 6,000 divided by 5 years for further depreciation. You will not consider the cost and do. Whatever is the carrying amount here, you will consider that and you will divide the revised useful life. The revised useful life is what, sir? The remaining is what? 5 years. So 5 years you will depreciate it. So you will take the revised residual value, you will take revised useful life. So see now here, I have written that if there is a change in useful life, residual value or depreciation method, we will use carrying amount instead of cost in SLM for calculating depreciation remaining for remaining future. So this is the formula. So what is the entry for depreciation? Debit, depreciation, credit, PP you used to pass, but you should not follow this. We should follow which one? You should follow this one. Debit depreciation, credit accumulated depreciation, and this will be transferred to P&L. So this was the important topic for your FR regarding depreciation. Now coming to the small topics, subsequent cost like repair and maintenance cost. Can I say repair and maintenance cost will normally be recorded where? The repair and maintenance cost will be recorded under operating category in P&L. But if there is a replacement part, that means what? Like in case of aeroplane, every 3 years or 2 years, the engine is replaced. What should we do? Whatever is the carrying amount of the old part, you will remove that and you will add the carrying amount of, you will add the cost of the new part. Then major inception and overhaul. Let us discuss this now. What is component accounting? Component accounting means what? As mentioned to you, if today I have an asset and that asset has significant component. If I say I have an aeroplane, in the aeroplane, the useful life of the aeroplane is different. The useful life of the engine is different. So what we do? We normally depreciate both separately. The aeroplane will be depreciated for 10 years, but the engine will only be depreciated for 5 years because the useful life is totally different here. If significant part have same useful life, then you can charge depreciation based on a single amount only. Now see here, If significant part is replaced, then what will happen? Carrying amount of the old part is de-recognized from the carrying amount of PP. Then cost of new part is added to the carrying amount of PP. So any balance, no recovery expense to P&L under operating category. So what will you do? Carrying amount of the new PP will be what? Carrying amount of PP on the date of replacement. You'll reduce the carrying amount of the old part, plus you'll add what? The cost of new part. You'll get what? The revised carrying amount of the PP. So the journal entry, you can see that you have disposed of an asset, you will have a gain or loss. That gain or loss, where it will be recorded? In operating category. Then coming to major inception. A major inception is a schedule or mandatory procedure to assess the safety, functionality, or compliance of asset. These inceptions are often periodic and essential for keeping the asset operational. This is required for aircrafts and ships. This will be mentioned by the government. The government will say that every 5 years you have to do the inception so that it will not create a problem to the asset, as well as the life also will not be at the risk for the public. So in initial cost of PP, the cost of inspection is already included. Therefore, depreciate that cost separately applying component accounting. If I say today you purchase a aeroplane of 10 lakh rupees, in this 1 lakh is relating to this cost. That means every 3 year you have to review it. So this will be recorded as an expense for 3 years. So 1 lakh divided by 3. When further the cost is incurred, in that case what we do, when further cost is incurred, we will treat this as per component accounting. We will remove this, we will again add the new value. Then coming to major overhaul cost, refers to significant repair or replacement. Same like your component accounting, you're removing a old part, you're including a new part. The old part which you're removing will have a gain or loss. Then spare parts, standby equipment. So this spare parts, how will you treat this? Such items are recognized in accordance with IAS 16 if they meet PP condition. If the spare parts or standby equipment or any small equipment which you have, if it meets the definition of IAS 16, that means expected to be used for more than one period, IAS 16. If not, it will be classified as an inventory. You can have a theory question from this topic. Then safety and environmental equipment. In this case, what should you do? You should capitalize to the cost of the PP. If you have seen in buildings, you have what? A fire alarms, all this. This all will be capitalized to the building. Fire extinguishers will be the no, small one. So that cost will be capitalized to the cost of the building. It will not be recorded as an expense. It will be treated as part of the building only, and it will be depreciated. Then coming to subsequent measurement. In subsequent measurement, what we have? Cost model. If the company is following cost model, what we do? Cost less accumulated depreciation, less accumulated impairment. You get the carrying amount. In revaluation model, what we do? Fair value on the revaluation date. Once you do revaluation, after that, whatever is your accumulated depreciation, that only you will consider. You will not look back and see what is the depreciation that was there in the accumulated account. Less accumulated impairment loss, that also should be after the revaluation. You'll get what? Net carrying amount. This will be presented in the balance sheet. Then coming to frequency of revaluation, if the value of the asset is significantly changing, you should do revaluation annually. If the value is not significantly changing, 3 or 5 years. But in your FR exam, it will be mentioned, if the revalued amount is given, fair value is given, please do the revaluation. Now coming to the next topic, revaluation will be applied to entire class of asset. Entire class of asset means what? Asset with similar nature and use. So see, accounting policy will apply to entire class of asset. Class of asset means what? Asset of similar nature and use. So the class of PP can be what? Land and building, machinery, aircraft, motor vehicle, equipment, furniture, fixtures, etc. Office building and factory building are different class of asset. These are not one class of asset. If the company is falling for office building cost model and for factory building revaluation model, it's okay, because the class of the asset is different. The use is different here. Then coming to revaluation approach. In revaluation approach, you have two methods in your FR which will be tested. Accumulated depreciation method. You will eliminate the accumulated depreciation. When you eliminate the accumulated depreciation, how will you eliminate it? By reducing the value of the asset. So you will debit accumulated depreciation, you will credit the value of the asset. You will get the carrying amount of this. Normally what we do, 10,000 is the value of the asset. 1000 is the depreciation, 1000 is the depreciation, 1000. So what do? You record this in what? Accumulated depreciation account. And then what do? Once the asset is being revalued, in that case, what we do? We say 10,000 minus 3,000, we get the carrying amount. So what we do? This 3,000 we are eliminating. How we are eliminating? By reducing the value of the asset. So now this 7,000 will be the carrying amount, and this you will compare with the fair value. So see here now, gross carrying amount minus accumulated depreciation will get net carrying amount. So if it's an increase, so you will take to revaluation surplus. If it's a loss, the value of the asset is below the carrying amount. In that case, what we do? Revaluation loss. It will be taken to P&L, or it will offset with revaluation surplus depending upon the year. So now see the treatment for revaluation gain or loss. If I say first time you're doing the revaluation and the first time we have revaluation gain, it will be taken to OCI, and this will not be reclassified to P&L. Once you dispose of a PP, that will be taken to retain earnings. It will not be taken to P&L. If it's a loss, sir, it will be taken to profit and loss under operating category. I hope everyone have understood the first time revaluation. First time revaluation gain, OCI, loss, P&L. Then subsequent revaluation. For the second time when you're doing, you have revaluation gain. For the second time, if you have a revaluation gain, that means you have to see, is there any revaluation balance or not? If previous year also gain, this year also gain, that means what? The current year will go to OCI. If this year it's a revaluation loss and previous year it was a revaluation gain, so we have to offset. Now see here, revaluation gain, previous year gain. So this year also will be taken to OCI. Now previous year loss, if previous year loss was there and this year we have gain, recognize gain in the P&L to the extent that loss recognized in P&L. Any excess gain will be transferred to OCI. So if you have recorded a 2,000 loss in the previous year, this you have a revaluation gain of 4,000. So out of that 4,000, first take 2,000 to P&L and then remaining 2,000 to OCI. If I say revaluation loss is the subsequent, previous year also loss, this year also loss, transfer to P&L, no issue. Previous year gain was there, this year loss is there. In that case, adjust revaluation loss to OCI first. Previous year you had gain, this year loss, this loss you will offset with the previous year. And if any excess loss is there, that will be taken to P&L. That will be taken to P&L. So the revaluation treatment is clear to everyone, I hope. Next one, transfer of revaluation reserve to retained earnings. That means what? You are transferring the revaluation reserve, whatever the balance was there in OCI. From OCI it went to OCE. Now from OCE, can you again take to P&L? No, this is not allowed. From OCI you took to OCE, and you will take to retained earnings. You will not take to P&L. So see now, what is the default method, sir? When should we take the revaluation reserve or the revaluation balance to retain earnings? Once the PP has been disposed of or de-recognized. When PP is de-recognized or disposed of, transfer the whole revaluation reserve to retain earnings. You will do that. You will decrease the value of revaluation surplus debit. You will credit the retain earnings. Option 2. This option 2, when will you follow this option 2? You'll follow when it is mentioned in the question. They'll mention in the question that the company is transferring the excess depreciation. In that case, so how will you calculate what is the amount you will transfer? Revaluation surplus may also be transferred to retain earnings during the asset is used by the entity based on what? Excess depreciation. Because once you revalue the asset, the depreciation will be more. So if the depreciation is more, P&L will say what? Gain is there, you have taken to OCI, but extra loss is there, that also you should take to OCI. But you will not take to OCI, we will record in P&L. But what we will do, whatever revaluation gain we have, that revaluation gain we will transfer to retained earnings. So how will you calculate the amount? Excess depreciation is what? Depreciation on revalued amount, depreciation on original cost. So once you depreciate an asset, once the asset has been revalued, the depreciation is 500. Before revaluation, the depreciation is how much? 300. So this 200 will be what? The 200 will be your excess depreciation. This is the amount which will be transferred from revaluation reserve to retain earnings. So I hope the transfer case is also clear to everyone. Then coming to the last part of the first time, that is derecognition. When will you derecognize, sir? We will derecognize the PP when it is disposed or when there are no future economic benefit. So note gain or loss on derecognition. So net proceed minus carrying amount, gain or loss will be recorded in operating category. So for revalued asset, transfer revaluation reserve to retain earnings. Whenever you dispose of an asset, what should you do? If there is a balance in revaluation surplus, transfer to the retain earnings. So derecognition is done. Then coming to the disclosure. Under disclosure, what are the disclosure? The measurement basis, cost model or revaluation model. What are the useful life and the depreciation rates? What is the method of depreciation? A reconciliation statement. Like your passbook. You have your passbook, no? Opening and closing. During the year, what is the inflow? What is the outflow? Same way, for the PP also, we have to prepare a reconciliation statement. If there is any addition during the year, if any asset has been disposed of, what is the depreciation charge, what is the accumulated depreciation, what is the gross carrying amount, and if any asset is classified as held for sale, you have to disclose that also. So with this, we have completed the discussion regarding IAS 16. Any doubts, anyone in IAS 16? You can ask me now. Any doubts, anyone? You have to say yes or no. As mentioned, this will be a two-way communication, not one-way communication. No, yes, no, 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 no. Okay, chalo then. Why I did detail IAS 16? Because IAS 40 and IAS 38 will be easy in that case. So now starting with the next standard. The next standard is what? IAS 40, investment property. A very small topic but very important for MCQ. Investment property. So what is an investment property? An investment property is a property that is land and building or both, held by owner or by the lessee as a right to use asset. Okay, in your IFRS 16, if you remember, you have lessee accounting and lesser accounting. In your F7, you only learn the lessee accounting. Lessee will record what? Debit right to use as a credit lease FD. That right to use asset also can be an investment property. That detail the examiner will not ask you. So two, it is given on rent and it should not be your business, or capital appreciation, or both, or use is not determined. If you have purchased any land, you have purchased a land but you have not yet determined the use, it will be classified under IAS 14. So see, rather than for use in business or sale in ordinary course of business, it should not, the company should not use this for business purpose or for sale in ordinary course of business. So some examples I've taken: property that is rented out to employees, IAS 16 I mentioned you. Property being constructed or developed on behalf of third party. Third party has given a building or a land to construct. That will be IFRS 15 revenue. That asset or the land will not belong to you. If the property is given on finance lease, property will be derecognized and hence no need for classification. It's not so important. Then land bought but no use is determined. Land is purchased but use is not determined. In that case, it will be what? IAS 40. Property which is constructed for future use as investment property, then IAS 40. You have purchased the land, you're constructing this, and this will be used for rental purpose and it's not your business, then IAS 40. So this is the definition of IAS 40. Then coming to the dual use of a property. Today what? Today you have a property, and this property, first floor, second floor, third floor, fourth floor. This first floor you're using for office, and these three floors you're using for mm, personal use. Personal use, let me say, you're renting it. Now, will you classify this building as IAS 16 or IAS 40? A doubt comes. In this case, what should we do? IAS 40 as mentioned, see what now. If a land and building is used for dual purpose, that means it is partly used for business purpose or partly let out. In that case, what we do, sir? More than one use. If it is separable, that means these four floors, if you can separate it, when can you separate it? That means we can sell each floor separately, or we can give this on rent, or legal title is there for each floor, separate legal title is there. That means what will you do? The first floor you will classify as IAS 16 and the remaining three you will classify as IAS 40. When? If it can be separated. Separated means what? It can be sold separately and legal title of both the portion is available separately. If it's not separated, sir, we are not able to separate, we are not able to sell the building, we are not able to sell each floor separately. Either we have to sell the full building, In that case, we have to see what? In that case, if the building is significantly used in business, then IAS 16. The full property will be classified as IAS 16. If insignificant business use, that means it's not used for business purpose. Now here, can we say that it is used for non-business use? It's the three floors are used for, the three floors are not used for business, only one floor is used for business. That means significantly the building is not used for business purpose. In that case, it will be classified as IAS 40. The whole property will be classified as IAS 40. So I hope this is clear to everyone, dual use of a property. So see now, if you can separate it, business purpose record as per IAS 16, if the second floor, third floor and fourth floor is let out, IAS 40. I hope this is clear to everyone. Then coming to ancillary services, this part, this one, all these can come in your MCQ. Ancillary services means what? One thing, if the ancillary services provided are insignificant, then it will be an investment property. If ancillary services provided are significant, it will be PP. Like hotel business, if I say today I have a building and I'm giving this on rent, in that case it will be what? A investment property for me. It will be an investment property for me. But I say, with I am providing this building on rent, as well as I am providing ancillary services, like I'm providing a lot of services. Like in the building you have swimming pool, you have gym, you can order food anytime whenever you want, it will be delivered at your doorstep, etc. All these services I'm providing, in that case I will say that I'm doing a business. I'm not giving the property on rent, I am giving the property on rent. But when you see from the substance over form, here we are doing the business, so it will be classified as PP. So just remember, ancillary service provided are insignificant, it will be an investment property. Ancillary services provided are significant, it will be a PP. Then coming to the next topic, consolidated books. Now, if you remember in the consolidation your group accounts, P company is the S company is the P company will P company has given a property to S on rent. In that case, P will say this is my investment property IS 40. P company will do what? P company will do the accounting as per IFRS 16 and record it as a right to use asset, and they will treat this as per IAS 16. Now, if I say in separate books, P in its individual financial statement will record IAS 40. S will record IFRS 16 and IAS 16. But when we say from a group point of view, from consolidation point of view, it's a single entity. In that case, this IAS 40 which you have transferred will not be a investment property. It will become IAS 16. It will become IAS 16. So see here now. Separate financial statement IAS 40. In consolidated financial statement, it is IAS 16, owner occupied property, because this S company, subsidiary company, is using this property for business purpose. If they're using this for business purpose, then when you do consolidation, you will say that, sir, it is not a investment property, it is a PPE. So with this, we have done with the definition. Now coming to recognition. Recognition principle. When should we recognize an investment property? When future economic benefits are that cost can be measured reliably. You will record it. Measurement principle, sir. What is the measurement principle? Initial measurement. Initially, it will be recorded as cost, subsequent cost. If it is capital expenditure, can I say we'll capitalize? If it's revenue expenditure, we will take to P&L. Under which category? Under which category? We will see. Now see here now. Same as IAS 16. Refer note number 3 for expenses to be recorded under operating or investing category. We will refer. Whether the revenue expenditure or repair and maintenance, it will be recorded in investing category or operating category. We'll see. Then in subsequent measurement, either the company can use cost model or revaluation model. Cost model is same as your IAS 16. Then revaluation. Is the revaluation model same as IAS 16? No. The revaluation model is not same as IAS 16. Here, whenever you have a gain or loss, that gain or loss will be taken to P&L, not to OCI. It will not be taken to OCI, it will be taken to P&L. So depreciation will not be charged. Depreciation also will not be charged. Once we select revaluation model in IAS 40, we will do what? We will record this into P&L. Revaluation gain will go to P&L. Under which category? P&L? Investing category. Investing category. So see here now. Depreciation is recorded under investing category. If a company chooses the revaluation model at fair value at the end of the financial year, no depreciation is charged for investment property during that year. This is the mistake which you will do in your exam. If a MCQ question comes, the question will say what? The question will be there. The question will say that the building value is 10,000. It's your investment property. Initially, you'll record at what? Cost, sir. But at the year end, the company is following fair value model. If the company is following revaluation model, then for this year, will you charge depreciation? No depreciation. Do not do the silly mistake in your MCQ question. Even though the company is using the fair value at the year end, because initially we'll record a cost on it. At each year end, fair value. In that case, this fair value will take into consideration the depreciation adjustment. Some important notes here now. NTD uses either cost model or revaluation model for all investment property. MCQ question, true or false? Whenever under IAS 40, if you are using cost model or revaluation, it will apply to each and every investment property. Here, that is the concept of class of asset will not apply here. Now, if model is changing, that means from cost model to revaluation model or from revaluation to cost model. Entity should not change from one model to other model unless the change will result in a more appropriate presentation. We have discussed this in IAS 8 also. That means cost model, fair value, cost model, fair value. This will not provide good information to the shareholders. But if it is providing more appropriate presentation, you can do. But IAS 40 states what? IAS 40 states that it is highly unlikely that a change from fair value method to cost model will result in a more appropriate presentation. So what is IAS 40 saying? If you shift from cost model to fair value, this is okay. But if you shift from fair value to cost model back, it is not providing better presentation. 99.99% shifting from fair value to cost will never provide fair presentation. See here now. Now coming to the part. IFRS 18 presentation and disclosure in financial statement require income and expense in SOPL are classified as in one of operating, investing and financing. So yes, here. Investment property that is unrelated to its trading activities. Investment property generates a return individually and largely independent of other resources. Therefore, holding investment property is a investing activity. IFRS 18 states what? IFRS 18 states that income generated by investment property will be recorded in, like your rental income. This will be recorded where? This will be recorded in investing category. If a building is there, I have given this on rent, I am getting the rent, I will record this under investing category. After that, income and expenses arising on initial and subsequent measurement of investment property, including gain or loss on disposal, fair value difference, depreciation, each and everything will be recorded in investing category. But what is the difference here? Let us see. Incremental expenses directly attributable to the purchase of sale of the investment property to the extent that the purchase expense are not recognized in the cost of the property. In this, that also will be recorded. That also will be recorded in investing category. So investing category income will be recorded, gain or loss, then your depreciation, fair value difference, everything will be recorded in investing category. Any incremental expenses directly attributable to the purchase of investment property will also be recorded where? Will also be recorded in your investing category that is not capitalized as the cost of the property. We have seen no IAS 16. In IAS 16, if it meets the definition of cost, we capitalize. If it does not meet the definition of cost, we take to operating category. Here, if it does not meet the definition of cost, we take to investing category. Then see no other income and expenses, example running cost, maintenance cost or repair, are presented in operating category. The difference here is this one. Like running cost, maintenance cost, everything will be recorded in operating category. It will not be recorded in investing category. An important point to note for your MCQ. Exam advice in FR, where a company holds an investment property, this will be supplementary to its other trading activities. You will not see a scenario in which a company main business activity is holding investment property. The examiner has mentioned that in your FR exam, if they mention investment property, it will always be IAS 40 only. IAS 16 will never apply to that. So I hope this is clear to everyone, which is important for your upcoming attempts. Now coming to the last important topic from this standard, transfer from investment property to PP, from PP to IP. In the recent mock, in your September mock, you had a question also, and I mentioned that this is the favorite topic of the examiner, and the question was there in your September. So now what is this? If from PP we are shifting to IP, if I say PP is at cost model, IP is at cost model, no issues. If I say PP is at fair value model, IP is also at fair value model, that is your revaluation model, no issues. Whatever, if I say today my value of the asset is 10,000, the fair value is 12,000. So this 2,000 will be treated as per old standard. What is the important point? Whenever there is a difference, that difference will be treated as per old standard. Once you treat this as per old standard, then only you can transfer. So for IP, what will be the cost? Initial value 12,000. The next one, if I say PP and IP is there, PP is at cost model and IP is at fair value model. In that case, I say today my carrying amount is, after depreciation, it is 10,000. Now, can you transfer this 10,000 to investment property? No, because investment property is using revaluation model. If investment property is using revaluation model, what should we do? We have to consider it. We have to revalue this first, then only we can transfer to investment property. So what we'll do, I say the value is 12,000. So again the difference of 2,000 will be treated as per old standard. What is the old standard? IAS 16. So it will go to OCI, and this 12,000 will become the cost here now. The next one, if I say PP is at fair value model, IP is at cost model. Now, if it is at fair value, that means what? 10,000 is the carrying amount, 12,000 is the value, 2,000 difference will be treated as per old standard. In OCI, you will record this, and what will be the value here? It will be 12,000. So, what is the crux here? First, sir, we have to revalue the building. If both are at cost model, both are revaluation model, no issues. If PP is at cost and IP is at fair value, and you're transferring from PP to IP, issue is that first revalue it, treat the revaluation case as per IAS 16, and then transfer the asset. For the next one, if it is from investment property to PP, in that case, what we do? If I say investment property, PP, both follow cost model. Will there be any issue? No issues. If I say investment property follows fair value, PP also follows fair value. In that case, if I say my investment property value is 10,000, the fair value is 12,000. This 2,000 we will take to P&L, not to OCI. Do not do this mistake. Then what will be the fair value? This 12,000 will become the fair value. And from here, this will be depreciated. Will you depreciate any asset as per IAS 40 if it is at fair value? No. Only the fair value difference will be recorded in P&L, and once it has been classified to IAS 16, it will be depreciated normally. Then case next one, IP to PB. I say that investment property is at cost model and IP is at fair value model. Now I say my cost is how much? 10,000. Can you transfer this 10,000? No, you have to first revalue it. I say my market value is 12,000. So the difference of 2,000 will go to P&L as per old standard. The old standard is what here? Investment property. Then the PP, then this 12,000 will become the value of PP, and this will be depreciated normally as per IAS 16. Next one, if I say IP is there, PP is there. IP is at fair value and PP is at cost model. Then what will you do? 10,000 is the carrying amount. Fair value is how much? 12,000. So 2,000 where will you take? To P&L, and this 12,000 will become the cost of the PP, and this will be treated as per IAS 16 normally from now. So I hope all the 8 cases are clear to everyone. So the question will be from which topic? No, the question will be from this one. Third one, and here this third one. Most of the time, if a question comes in section A MCQ. But now on the other side, inventory to investment property. From IAS 2 to investment property you're going. In that case, what will happen? Property is remeasured to fair value on transfer, and any difference between carrying amount and fair value is recognized immediately in operating category. Understand? Here we mentioned, sir, here in this case we mentioned fair value will be recorded in investing category. If it's IAS to inventory to IAS 40, in that case investment property is following fair value. Your IAS2 will never follow fair value. They will IAS2 will follow lower of cost or NRV. In that case, what should we do? We have to revalue it, remeasure the whatever is the difference will be treated under P&L. Under which category? Operating category. Under operating category, not under investing category. So in this chapter, these are the two important things which you have to remember, because changes is there in IFRS 18. So MCQ question can come regarding this topic. So what are the disclosure? Disclosure what? Accounting policy, assumptions, whether cost model is used, revaluation model. If cost model is used, still the company have to disclose what is the fair value of the property. If the company is using revaluation model, they have to disclose what will be the carrying amount of the asset if we follow cost model. Then any restriction is there, or did you keep this a property, investment property, for any security purpose with any bank? You have to disclose detail of income and expense for such investment property. What is the income or expense during the year? In one line you have to mention, and whether an independent valuer was used to calculate the fair value or not. With this we have completed the revision of your IAS 40. Any doubts in IAS 40 investment property? Key points are mentioned which you have to remember for your upcoming exam. No?
No,
Oh,
sir.
okay, Shika. Others? Okay, chalo then. As mentioned, the focus will be what? Revising the standard and express. Yes, I mentioned we have to cover each and point I'm doing in detail. So this is a revision. It's not a detailed class. If this was a detailed class, we would have done in full detail, taking examples also and a lot of questions. But as of now, we have to do the revision. Yes. So you can do what? Once the video is uploaded, you can see on YouTube by reducing the speed. So now coming to intangible asset, the next important topic, which is very important for FR also for MCQ. Now chalo. Intangible asset. Now what is intangible asset? It's a very simple definition. Intangible asset is what's identifiable, non-monetary asset without physical substance. So okay, physical substance will not be there. It's a non-monetary asset and it should be identifiable. If in exam, if a question comes regarding, let's say, MCQ question, and it is very tricky from IS 38, it will be from this topic only, identifiable. Other than this, the examiner will not ask you. So intangible asset, sir. Intangible asset is what, sir? No physical substance. Should not be tangible. Tangible means what? Physical substance is that. Intangible means it should not be tangible. It should be monetary asset. It should be non-monetary asset. So non-monetary, monetary, where do we cover in IS 21? That we'll discuss. But as of now, what does non-monetary means? The currency or the amount which you get is not fixed. The not realizable in fixed or determinable amount, and it should be held for use. It should be used for the business purpose. It should be under the control of the entity. So the term control means what? Power to obtain economic benefit and ability to restrict others. So this definition of control we'll cover in IFRS 15 also in this step number 5. So what does control means? Power to obtain future economic benefits and ability to restrict others to take the benefit. Then you say, what's up? We have control on the asset. It should be identifiable. Identifiable means what? Identifiable means it should be separated from the entity and can be sold. Either it can be sold, either it can be given on rent, either it can be transferred, a lot of things, or it can be exchanged, or it arises from a legal contract. When will you say that, sir, a following thing is identifiable? Either you can separate and sell in the market, or it arises from a legal contract. Now, when coming to internally generated goodwill, do we record internally generated goodwill? No. Why? Because it's not identifiable. Can you sell the goodwill? No. Goodwill will arise when we sell the business. We can't separate the goodwill and sell in the market. No. Or it arises from a legal contract. It is not arising from a legal contract. But in your consolidation, if you remember group accounts, when you prepare consolidation, you do step number 3, goodwill calculation, and that goodwill will be recorded in the balance sheet. Why? Because it is arising from a legal contract. Because we are purchasing a company, when we purchase, a legal contract is there. And then having future economic benefits and cost should be measured reliably. If these 5 conditions are being met, we say that, sir, it is an intangible asset. If the any one of the condition is not being met, you will not record this as an intangible asset. What will you do? If all conditions are not satisfied, then amount will be expensed to P&L under operating category. So what are the example? Trademarks, copyrights, patent, franchisee, computer software, customer list, etc. These are the examples which are mentioned. These are the example for intangible asset. Should you record this or not? It is different. We have to see recognition criteria. Now see some important notes for your MCQ. Market share is not an intangible asset. It's not identifiable. You can't sell the market share in the. If I say today we are into chocolate business and we have 40% shares, 40% share in the overall industry, can I sell this 40% share? Can I separate this and sell it? Never. That means it's not identifiable. So market share will never be an intangible asset. Marketing and advertisement cost, will this be an intangible asset? No, because certain it is not there regarding future economic benefit. It's not certain that you'll have future economic benefits. Coming to staff training cost, will the staff training cost be an intangible asset? No. Whenever you pay salary to the staff also, that is also not an intangible asset. It's a normal expense. If the company is incurring some training cost on the staff, that time also it will not be an intangible asset because control is not there. So for MCQ, these are the questions. Then coming to the other topic which is important for MCQ, combined asset. Combined asset means what, sir? Tangible and intangible assets are together. Like when I purchase a laptop, with laptop, my laptop is what? I can see and touch it. But when coming to the software, Windows, etc., can I touch it? No. So now combined tangible and intangible asset. In that case, what should we do? If the amount of tangible asset is material, significant, record a whole asset under IAS 16. That means laptop purchase along with the general software. So the full amount which I pay, if I pay 1 lakh rupees, I know that out of that 1 lakh 95,000 belongs to the laptop and 5,000 belongs to Windows. But what will I do? I will record this as an intangible asset because the significant amount here I'm paying for the tangible part, that is the laptop. Other way, if amount of intangible asset is material or significant, record whole asset under IS 38. The example is what? Software purchased in a CD. The CD cost will be how much? 10 to 20 or 30 rupees. But in that, the software which is there, which cost 10,000, 12,000. In that case, the full amount which you pay will be recorded as an intangible asset. If amount of tangible and intangible is material, allocate total amount into tangible and intangible. That means if the amount which you're paying is significant for tangible, it is significant for intangible. If you're able to separate it, do it. See now example. Laptop purchase with a specialized software. When you purchase a laptop, you purchase what? Windows also. So laptop plus Windows will be recorded as per IAS 16. If you purchase some specialized software like Tally, if you purchase some subscription of any software, that will be recorded as per IAS 38. IAS 38. In the normal class, in a regular class, we have done a lot of MCQ regarding this topic, and we have seen how the MCQs are tricky from this part. What did I mention? One important thing here. If today I have a asset, today my PP is there. This PP is costing 10,000 rupees, but my intangible asset is costing how much? 20,000. So you will say, sir, intangible asset is significant. But I say this intangible asset is significant. This intangible asset will be used to operate this tangible asset. This intangible asset will be used to operate this intangible asset. In that case, this full 30,000 I will classify as what? I will classify as per IAS 16. This is mentioned in IAS 16 that whenever the cost which you're paying for what? The cost which you're paying for intangible asset is more, still it can be classified under IAS 16 because this intangible asset is very important to operate this asset. Without this, we can't operate the machine and can't do business. In that case, this intangible amount which you're paying, tangible, both will be recorded as per IAS 16. Then coming to recognition principle. Already we have covered, meets the definition of intangible asset, probable future economic benefits, cost should be measured reliably. Now measurement principle, it's initial measurement, same as your IAS 16. Mostly your subsequent cost in IAS 38, the subsequent cost will mostly be recorded in operating category. There are very less chances that the subsequent cost will be capitalized because it will not enhance or the future economic benefits will not be more. Subsequent measurement, cost model, revaluation model, it's same. Everything is same. Now coming to purchase of intangible. So we like purchase as purchase price, you will reduce trade discount, non-refundable taxes you'll add, professional fees, some commission, some testing costs, etc. You will have the cost of the asset, same as per IAS 16. So debit asset, credit bank. What are the costs that are excluded? So we have seen staff training cost, marketing advertisement, general administrative cost, startup cost, inauguration. Everything will be recorded under operating category. Everything will be recorded under operating category. Now coming to goodwill. Sir, internally generated goodwill, will you record? No, because it is not identifiable. MCQ question. Purchase goodwill. Will we record purchase goodwill? Yes. Why purchase goodwill? Because it is arising from a legal contract discussed as per IFRS 3, a business combination. So how do we calculate goodwill? If you remember, purchase consideration minus fair value of the net asset. Now coming to internally generated intangible asset. If internally generated intangible assets are there, like your self-generated intangible asset that are automatically developed, like if I say, if today Super Infinity is a brand, can I say in the coming 1 year or 2 year, 3 year, it will become a brand? Can we record the Super Infinity as a brand in the books of Super Infinity education? No. Why? We do not know what is the cost we have incurred to make this brand. So generated automatically without incurring any expenditure. Expenditure will be done, but you will not be able to identify how much is the expenditure you're doing. So goodwill, brand name, master heads, publishing title, and customer list cannot be measured reliably. MCQ question. Cannot be measured reliably. Cost cannot be measured. Then coming to research and development. Research, what we do, sir? Research will normally take to P&L operating category. So development cost, will we capitalize development cost? Yes, sir, we will capitalize development cost. When will you capitalize development cost? If criteria is being met, pirate criteria. That is what? Probable that future economic benefit will be there, intention to complete the project, resources are available, ability is that to sell, and it is technically feasible or technically possible to complete or to complete the development, and it will turn into asset in future, and expenditure should be measured reliably. If these 5 conditions are being met, then what we do, we will, if these 6 conditions are being met, then we do what, we will start capitalizing the development cost from that day. So in your FR exam, straightforward, it will be mentioned in the question that okay, on 1st August it is technically feasible. So from 1st August, whatever is your development cost will be capitalized. Before that, it will go to P&L. The examiner will mention the dates, so use it and calculate the amount that will go to P&L and calculate the amount that will be capitalized. So expected to profitable and ability to sell we have discussed. Now some important notes for MCQ. Cost of internally generated assets to be capitalized starts from the day when development phase begins. Development phase will begin when 6 criteria are being met. Development expenditure once recognized in P&L cannot be restated. Once you have recorded a development expenditure into P&L, you can't again classify this as an asset. If the entity cannot separate between research and development phase, everything will go to P&L. Everything will go to P&L. So then subsequent measurement means a cost model, revaluation model. Now, is it possible to follow revaluation model in IAS 38? It's very difficult. We have seen in the class. It's very difficult to follow revaluation model for your IAS 38 because the intangible assets are not traded on any market. Because we follow, when we calculate fair value, we follow IFRS 13. We follow what? IFRS 13. IFRS 13 says what? Principal market. What is principal market? Market where the goods, where the assets are traded in a high volume. Intangible assets are never traded in high volume. So it becomes difficult. So let us see the note. Fair value should be determined by reference to active market. Active market means what? Where the assets are sold on a frequent basis. That means the volume is very high. IAS 38 states that active market for intangible asset is rare and specifically prohibits revaluation of patent. So see, now this is a MCQ question which frequently repeats in the exam. IAS 38 prohibits the revaluation for patent, brand name, trademark, customer list, master heads, publishing title because it's difficult to calculate the fair value. Then coming to the frequency, it's same as your IAS 16. Revaluation gain same as your IAS 16. Revaluation approach is also same as your IAS 16. Transfer case is also same as your IAS 16. Revaluation, the class of asset is also same. Now, as mentioned, following the revaluation model for intangible asset is little bit difficult. If in the exam MCQ question comes regarding this topic, be aware and do the right answer. So now coming to amortization. What is amortization? Amortization is a type of depreciation for intangible asset. So amortization will start when, sir? Amortization will start when an asset is available for use. So this is a very important topic. If you have solved your past papers, you would have seen this type of questions in MCQ. In some practical cases, commercial production is the first point when the asset is actually used, and management only considers it available for use at that point. Sometimes what will happen in the question, they'll mention what? It's a research phase. The research, the development is completed here. So you'll say what, sir? Development cost is 10,000. From the next day only you should start amortization. But in the question they will say what? In the question they'll say 1 month. After 1 month, the asset will produce commercial benefits or will be used for commercial production. In that case, amortization will start from this date. Amortization will start from this date. For this 1 month, you will not charge amortization. We have done 2 to 3 MCQs regarding this topic. So amortization stops when the asset is held for sale under IFRS 5 or it has been sold, same as your IAS 16. Amortization table, amortizable amount, that means what is the maximum amortization you can charge? Cost minus residual value. Cost minus residual value. In most of the cases, the residual value for intangible asset is 0. 99.99% it will be 0. So that is the reason in your exam questions, never the examiner will give a residual value for intangible asset. They'll give the cost, they'll give the useful life. Simple. Amortization method. What are the methods? SLM, WDV, unit of production method. But the priority should be given to what? But the first preference is that amortization should be based on the ratio of expected benefit. MCQ question. What? Ratio of expected benefit. So the first preference will be given to what? Based on ratio of expected benefit. As the intangible asset is providing benefit, record the amortization. Then fifth one, amortization does not ceases when an intangible asset is temporarily idle. Yes or no? Amortization or depreciation will not stop if the asset is not available for temporary purpose, unless it is fully amortized. If it's fully amortized, then no need to charge amortization. Amortization is recorded under operating category. So useful life, in case of useful life, if useful life is available, we will amortize. If useful life is not available, then what we do? Annual impairment test we do. Whenever there is an whenever there is an indication of impairment. So if the useful life is not determined, what we do? Annual impairment review. In the September pre-mock also you had an MCQ question regarding this. Many students have done mistake in that, but in the class, and I'm mentioning now also, intangible assets which are not amortized, you have to do impairment review annually, even though there is no indicator. In IS 36 we learn what, sir? If there are indicators, we do we do amount indicators, we charge impairment. But for intangible assets which are not amortized, which are under development phase, which are not amortized, and goodwill, these are the three things where every year annual impairment review is compulsory, even though hint or indications are not there. This point is clear to everyone. Then coming to contractual or legal right. Contractual or legal right. This contractual or legal right means what? A simple thing. Let me explain. Today I say that Reliance has taken what? Reliance has taken your 5G rights, intellectual rights, and this will be treated as an intangible asset. In that case, they have the right for what? Reliance will have the right for 10 years. But Reliance also knows that this 5G will not continue for 10 years. They know that after 3 to 4 years, 6G will come, 7G, etc. will come. So in that case, 10 years is the life, or 10 years is the period which they have to use this. But Reliance knows that the benefit which we'll get from 5G will only be for 6 years. Then the amortization should be based on 6 years, not on 10 years. In the contract, it is written 10 years, but Reliance knows that technology will change frequently. In that case, amortization should be based on 6 years. So see now, the useful life shall not exceed the period of the contract. That means this useful life of 6 years cannot exceed 10 years. It can be less than it, less than. But will may be shorter depending on the period over which the entity expects to use the asset. The company gets to know, okay, for the coming 4 years only, we will use this intangible asset. After that, we will not use. Even though the contract is done for 10 years, the amortization will be done for 4 years. If the contract is renewable, then useful life of the intangible asset shall include renewal period only if there is evidence that the entity will renew it without significant cost. So today I say what? I purchase an intangible asset. The use I have taken this for 3 years. So I'll charge amortization for 3 years. But I say that I can renew this. I can extend the useful life. I can renew this. If I can renew this and the amount which I pay is very less, let's take I'm only paying 10 rupees to extend this for 4 years. In that case, what will I do? I will revise my useful life. Instead of 3 years, I will take it as 10 years for amortization. If the amount which I pay is significant for the coming 7 years, the amount which I pay is significant. In that case, amortization will be recorded separately for 3 years. After 3 years, again you will record an intangible asset and you will amortize it. If the cost is significant, it represents in substance a new intangible asset. As mentioned, after 3 years, you will record one more intangible asset and amortize for 7 years. If the amount which you pay for renewal is very less, then it will be one only, one intangible asset that you will amortize it. So see now, annual review of the method of amortization should be done. Same as per your IAS 16 which we have discussed. So when will you derecognize? Derecognition will take place when intangible asset should be derecognized when it has been disposed or when there is no future economic benefits. So gain or loss, how will calculate? Net proceed minus the carrying amount. So gain or loss will be recorded in P&L under operating category. So for revalued asset, if you are following revaluation model, what do? We will transfer revaluation surplus to retained earnings. What we do? We transfer to retained earnings. I hope this is clear to everyone. सबको clear है? With this, we have completed 3 standards and disclosure. So let us see disclosure. What are the disclosure? Whether the useful life is definite or not. Indefinite, you have to mention what is the gross carrying amount, what is the accumulated amortization. If it's indefinite useful life, you have to mention what is the research expense you have recorded, what is the amount you have capitalized in case of development development cost. Then revaluation, from what day, what is the revalued amount, what is the difference, what is recorded in OCI, how much is recorded in PNL, etc. So with this, these are the 2 things which we have completed. Now coming to the next standard, IAS 23. IAS 23 is what's a borrowing cost. Is this very important? Yeah, very important. You can, this will be tested for 2 to 4 marks, not more than that in the exam. So borrowing cost, MCQ is very important. See now, borrowing cost of what? Normally when I take a loan, what we do? We pay interest. That interest we record in P&L as an expense. But this expense which you record in P&L can be added to the cost of the asset if the criteria are being fulfilled as per IAS 23. Then this amount which you record to the cost of the asset will be recorded as an expense over the period as and when the asset is amortized or depreciated. Borrowing cost are interest and other costs. Okay, it includes interest cost, also other costs that an entity incurs in connection with borrowing of funds in order to construct an asset. It includes what, sir? Interest expense calculated using effective interest rate. If you remember, effective interest rate will include what? Premium, discount, issue cost. All these are what? Borrowing cost only. Then interest in respect of lease liability. The lease liability, the interest which you have, that also can be capitalized. Then one, exchange difference. This will not be tested. This one, preference dividend, when the preference capital is classified as debt. If there is a preference share capital and that preference share capital is a liability as per your IFRS 9, in that case the preference dividend which we pay can also be your borrowing cost. For MCQ, what is important? 1, 2 and 3. First point, second point and fourth point for MCQ. Coming to recognition, sir, borrowing cost. Normally borrowing cost is recorded to P&L as an expense. In which category? Financing category. But if borrowing costs are directly attributable, okay, it is directly related to what? Acquisition, construction or production of a qualifying asset. In that case, what we say? In that case, we say it should be capitalized. So now what is QA? Qualifying asset means what? Asset which takes a substantial period of time. SP, that means more than 12 months. Substantial period of time is not defined by IS and IFRS. It's a general assumption that it's 12 months. It depends on company to company. So substantial period means what, sir? It is based on entity's judgment and must be disclosed in notes to account. Generally, it is 12 months. So if this condition is satisfied, then we can capitalize the borrowing cost. Now coming to the period of capitalization. When should you start the capitalization? Even though, let me take an example. See here now this timeline to understand this part. I say that the company has taken the loan on this date. But on this date, on 15th, the loan has been taken on 1st January. But on 15th January, some activities were undertaken by the company which are required, like approval from the government or some local body to start the construction. Then the construction started on 1st February. In that case, the capitalization will start from 1st February. This 1 month expense, this 1 month interest expense will go to P&L. So the amount, the interest cost will capitalize from what date? The interest cost will be capitalized from 1st February. So now see, capitalize commencement date when all conditions are satisfied. Expenditure on the asset is incurred. That means you're incurring some expenditure. The expenditure can be either you're paying cash or either you're giving some asset also. Borrowing costs are being incurred. That means interest cost has started. You have taken the loan. As you take the loan, interest cost will start. The bank will never say that okay, after 1 month you're starting construction. Okay, after 1 month we will start the interest calculation. No, they'll say today you have taken the loan. From today, interest expense will be calculated. Activities necessary to prepare the asset for its intended use or sale have started. Whichever activities are required to start the construction, like government approvals, some permissions, they have, if it is taken, then we say what? All when all these three conditions are being met, that means later of these three dates. Later of these three dates. In your exam question, it will be specified. So please read the question carefully. Avoid silly mistake in this. Either one or two dates will be given. Read the question carefully. So now, sir, when will you stop? When we will stop the capitalization? Capitalization will stop when once the asset is ready for use. Once the asset is ready for use, what we do? Once if an asset is ready for use, we stop capitalization. So now here it is important what? If minor modification is pending, it will not be considered. If I say today, I have constructed my house, I can start living in this house, but still some electric work is pending here and there. I have to uh, do some electric work. I have to do some modification, like I have to bring curtains, then sofa, etc. In that case, these are modifications which are pending, but these are minor modifications. But my structure of the house is completed, I can start living in this. Okay, you can stop the capitalization, understand that. Capitalization will cease when substantially all the necessary activity to prepare the qualifying asset for intent use or sale are completed. Minor modification like decorations will not be considered. If here and there some work is pending, some painting is pending on this wall, I need some other painting, etc. It can be done later also. So note, see an important point here. If entity complete the construction of a qualifying asset in part, that means what? If I say this is a building and this building I've completed first floor, second, third, and fourth floor. Once I complete the first floor, I can give this on rent. I'm giving this on rent. In that case, I will stop capitalization. Even though my building will take 1 year, but this first floor got ready in 6 months. Now, still, I require 1 year to complete. Now, the amount which is used for the construction of the first floor will, the interest will stop to be capitalized in the cost. It will go to P&L. For MCQ, it's important. Now, sir, can we stop capitalization? Yes. Capitalization will stop. Capitalization should be suspended during extended period in which active development is not taken place. That means active development is not there. But if I say when we are constructing the house, we do watering, curing, we do. In that case, it's a necessary part. It is required for the construction of the asset. In that case, we will capitalize it. If I say the labors are on strikes, etc., if the labors are on strike for 1 month, construction is not happening. In that case, for that 1 month, we will not capitalize the cost. We'll take to P&L under financing category. See, capitalization will not suspend if there is a temporary delay which is necessary part of the process of preparing an asset for intent use or sale. The process, the 15 days which we give after the construction, it is important so that the base will be strong and there will be no issue in future. So that 15 days or 1 month, we will still capitalize it because it's the part of the production during a period when substantial technical and administrative work is carried out. Even though construction is not done, but here and there some other work is done, the company is working on the project, still we can capitalize, it will not suspend. This detail the examiner will not ask you, the dates will be given for MCQ purpose. I mentioned this, the examples which I mentioned later of these for MCQ purpose. You can't say anything can come in the exam, so you have to be prepared. So expenditure means what, sir? Expenditure means we are doing the payment, transfer of asset is there, or etc. Then expenditure are reduced by any progress payment received. If any government grant you have received, you will reduce the expenditure. So activity means what, sir? Construction has started, some technical or administrative work is done. Activities excluded are what? The asset active development is not done. No work is done on the asset. In that case, we say that we will stop the capitalization. So I hope this is clear to everyone, the period of capitalization. Now, capitalization of borrowing cost. Two things are there here, which is very important. Specific borrowing, general borrowing. For specific borrowing, what we do, sir? You take actual borrowing cost incurred on the specific borrowing, the total amount you take, less any income on temporary investment of specific borrowing. Here in specific borrowing, do we consider the date when the fund is used? No. You will not consider the day, you will not consider the date when the fund is used. If I say today the company has taken a loan of $10 million specifically for the construction of a factory, it's specific borrowing. Now the company is saying that today we are using what, 5 million, and after 6 months we are using 5 million. Will you take 5 million into 12 divided by 12 plus 5 million into 6 divided by 12? No, this is not done in specific borrowing. Avoid this silly mistake. This is done in general borrowing. So you will not consider the day, you will not consider the date when the fund is used. But for this 5 million, can I say about this 6 months you have some temporary income, that temporary income you will reduce from the interest cost which you get. So see here now, note, actual interest cost on specified borrowing irrespective of expense incurred on qualifying asset on different dates. That means date the amount is invested is considered for interest calculation in what, general borrowing. When you do the calculation for general borrowing, the date when you use the fund is considered. So for general borrowing, what do we do? For general borrowing, the first step is what? Calculate the capitalization rate, the weighted average cost of capital you have to calculate. How do you calculate? You will take the total interest, you will take the total interest expense. If you have taken a 10,000 rupees loan from ICICI Bank, you have taken from Axis Bank, you have taken from HDFC Bank, it could be at 9%, it could be at 9.5%, it could be at 8.5%. So what you do, you will apply on this 900, you will say 950 plus 850 and divided by the total, that is of 30,000. It's what? 30,000. You'll consider this. And then you will calculate the weighted average cost of the capitalization rate. Then what you do, this capitalization rate you will use for calculating the interest expense. And when you calculate here, only expenditure incurred, that means the date when we use the fund is considered. If I say today I'm using 5 million and after 6 months I'm using 5 million, that means 5 million into the capitalization rate into 12 divided by 12. 5 million into capitalization rate into 6 divided by 12. So avoid these mistakes here. I hope to everyone this is clear. Some important note here now. Note, always use first specific borrowing, then general borrowing. Whenever you want to construct any asset, first use what? Specific borrowing, then go for general borrowing. Borrowing cost capitalized cannot exceed the actual borrowing cost. That means the interest which you're paying is 10,000. You can't capitalize 11,000. This will not happen also. Then third one, inventory manufactured in large quantities on a repetitive basis over a short time are not classified as qualifying asset. For MCQ, very important. MCQ, very important. Use for specific borrowing, then general borrowing. Inventories manufactured in large quantities. If the inventories are manufactured in large quantities, can this be a qualifying asset? Never. For the inventory to classify as a qualifying asset, what should be done? It should take substantial period of time. It should take more than 1 year generally. It should not produce on a regular basis. It should be a unique product. It should be a customer made or non-repetitive. The inventory should not be produced on a repetitive basis. Then only we can capitalize the cost. For inventory, when will an inventory be a qualifying asset? It should take a substantial period of time and it should not be produced on a regular basis. If both the conditions are satisfied, then we say it's a qualifying asset. Asset ready for the intent, use or sale when acquired are not classified as qualifying asset. So means what? Asset ready for the intent use. That means what? Today I took a loan of 1 lakh and today only I purchased an asset, and from tomorrow only I can use this asset. Will I be able to capitalize this interest cost on this? No. If I purchase a building and from tomorrow only I can use it, in that case interest cost will not be capitalized, it will go to P&L. But if I say I purchased a building and I'm doing some renovation for, it will take 1 year, in that case you can capitalize it. Qualifying asset measured at fair value, IS 23 will not apply in like your biological asset, your animal, sheep, plant. In that case borrowing cost will never apply. Then borrowing cost will not include notional cost of capital. That means notional cost of, this is also important for MCQ, like equity shareholder return. Equity return. That means your shareholders will also be there, no? The equity shareholders will also demand some return. In that case, this will not be considered. In that case, it will not be considered. Understand that. Notional cost of capital will not be considered as a borrowing cost. Preference share capital, if it is classified as a debt, then we consider it as a borrowing cost. If it's a equity and on that equity we are paying some dividend, it's a equity, you're paying dividend, that dividend will not be what? Borrowing cost. Disclosure, what are the disclosure? Capitalization rate used, the amount of borrowing cost capitalized in the period. What is the amount which you have capitalized? What is the amount you have recorded in the P&L as an expense? And what is the capitalization rate? So with this, your IS 23 is also completed. Any doubts, anyone? Chalo, chalo, say me, any doubts, anyone? Shreya saying yes, it's good. Others? Raj,
No,
what
sir.
about you? Okay, no doubts. Ragini also mentioned no doubts. Okay, 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 okay. Now we'll do one more standard, then we'll take 10 minutes break and come back and do the remaining 3 to 4 standards. So now let us do the next standard, IS 20. IS 20, accounting for government grant. A very easy topic, very, very important. I'll mention, I will say you, you should avoid mistake. What are the mistakes you'll be doing in the exam? You should avoid that. So IS 20, accounting for government grant and disclosure of government assistance. Now, sir, this will be applicable to what? This IS 20 will teach what, sir? Accounting and disclosure of government grant and disclosure of other forms of government assistance. So we can see accounting for government grant and disclosure of government assistance. That means the government assistance which you get will not be accounted, it will only be disclosed. Definition now. It will not be applicable. See now, grant covered under IS 41. We will discuss IS 41. So grant, if the government grant is there and that government grant is related to IS 41 agriculture activity, it will not be considered. Government participation in the ownership of an entity. If a government is participating in the ownership of entity, IS 20 will not apply. Any tax benefit the government gives will not consider this as a government grant. For MCQ, this is important. This C point. Now government. So government refers to what? It can be local, national, international, any government agency or etc. Government grant means what, sir? Assistance by government in the form of transfer of resource to an entity in return for past or future compliance. Either you have done something good in the past or either you will do something good in the future. The government will give you some grant. The grant can be what? Either it can be in cash or either it can be in kind. The government will give you amount or the government will say that we'll give you an asset. If you're doing betterment for, if you're working for the betterment of the society, if you're working on solar power plants, the government will say that we will provide the solar panels. In that case, the government is providing you grant in the form of kind, not in the form of cash. Government assistance. Then action by government designed to provide an economic benefit specific to an entity or a range of entity qualifying under certain criteria. That means government will provide some economic benefit to a group of companies in a particular industry. Like, what are the examples of free technical advice? If let's take, we are into solar business, the government could provide some data regarding, okay, what is the temperature in which area the sun is, or the sun rays are very high, etc. A lot of things. Free marketing advice of providing guarantees, like if it's Ambani needs a loan, Ambani will call to Modi saying that I need a loan, please inform the SBI chairperson to provide me a loan of 10,000. So these are all what assistance which are provided by government. Now, will you do the accounting? No, you will only disclose in the notes to accounts. So now, like road facility, fuel price are reviews, these are provided to public at a large. It will not be to a specific entity, etc. The road facility which the government is providing, the fuel price, if it has been reduced, then this is provided to a large public. In that case, it will not be considered as what government assistance. Then government assistance is not recognized because it cannot be calculated. It shall be disclosed through notes to accounts, which include the nature of benefit and the timing of benefit. So you should mention what is the nature of the benefit and the time period of that benefit. For how many years will you get the benefit? So now there are two types of grant: grant related to asset, grant related to income. Grant related to asset means what? Are government grants whose primary condition is that an entity qualifying for them should purchase, construct, or otherwise acquire a long-term asset. Either the company should construct, purchase, or acquire long-term asset. Related to income means what? You have incurred some expenditure. The government is saying that go in a village and start a factory and employ, and please employ the local people. So if you employ the local people, 80% salary we will give, 20% you have to give. So this is what grant related to income. So now recognitions are very important. Recognition: government grant should be recognized only if there is reasonable assurance that entity will comply with the condition attached to them and grant will be received. Even though today the government did not pay you, but you believe that you will receive this because you're fulfilling the condition and you're complying with the conditions, and you know that the grant will be received, you will record today only grant income. So debit receivable, credit grant income, you'll record it. Even though amount you have not received, you have MCQ can come. Even though amount is not received, but there is assurance. That assurance is what? Reasonable assurance that you will fulfill the condition and you will receive the grant. In that case, we record it. So now types of grant related to income and asset. Asset is capital grant, revenue grant. Now see accounting treatment. Note, government grant can either immediately credited into financial statement or recognized as a deferred income liability and credited into P&L over the period. So there are two things. Either you can record straightforward the income into the P&L, or what should you do? Or you should record this as a liability, and over the period you have to record into the P&L as an income. So grant related to asset, monetary government grant. That means the government is giving you amount, cash. What is the method one, sir? Can I say the method one is what? You purchase today an asset for 10,000, you get a grant of 2,000, you deduct it. So ultimately, what is the amount? 8,000. This 8,000 is the value of the asset, and this value of the asset will be depreciated as per IAS 16. So method one is what? Deduct the grant from the cost of non-current asset, and then normally treat the asset, this 8,000, as per IAS 16. Method 2. In method 2, what we do, we will not reduce the amount which we receive from the government from the cost of the asset. Instead, what we do, we record this as a deferred income, deferred government grant. So recognize grant liability as a deferred income and transfer a portion to P&L each year. Each year you will be transferring to P&L. If I say government have given me a grant of 2,000, so they mention that the asset should be used for 5 years. So divided by 5 years, every year 400 I will record into the P&L as an income. Now, if we record into P&L 400, so what will be my closing balance? Can I say my closing balance will be 1,600? So this 1600 will be recorded as a liability. Now you have to separate it. You have to record current liability and non-current liability. So non-current liability will be what? Non-current liability, you have to separate current liability. Current liability will be for the next 12 months. The amount which will take into the P&L for the next 12 months will be a current liability. For the next year, I say 400. So remaining 1200 will be a non-current liability. You have to separate this and record it. In your single entity question also, if a grant question is there, please record it separately. You will be getting full marks. If not, you will get only half. So see now, method 2, if it is regarding depreciable asset, that means it's regarding a depreciable asset. The asset is depreciated. In that case, what we do, transfer to P&L the deferred income in the ratio of depreciation. So ratio of depreciation, normally it will be SLM basis. So 5 years, 6 years. If it's based on WDV, then see what is the depreciation amount, then transfer it. So what is the entry? So debit asset, credit bank, then debit bank or grant receivable, credit deferred income you record as a liability. Then what do you do over the year? So debit deferred income, we reduce the liability and we take into P&L. Now which category P&L? Other operating income. Important point to note. Other operating income. It's what? Other operating income. In your P&L, we have no operating profits. Before that, we have other operating income. It will be recorded there. That means ultimately it will go to operating category only. Then see now, for non-depreciable asset, if it's a non-depreciable asset, if there is no depreciation, there is no depreciation, then what should we do? In that case, the amount which you transfer to the P&L will be based on the conditions which is given. Now, when coming to land, for land there is no useful life, but the government will say that you have to use this land for 15 years. Then for 15 years we have to take into P&L. If it is unconditional grant, the government is saying that there is no such condition. If there is no condition attached, directly recording to P&L as an income. Under which category? Other operating income. That is operating category. So I hope this is clear to everyone, the monetary government grant. Then coming to the next one, this what? Deferred income. Can I say deferred income, sir? Current liability and non-current liability. Please calculate this properly. Please see the number of months. The examiner will change the number of months. Either they'll say that the grant was received after 6 months. So if your year is what? If your year is what? 1st July, 1st January and 31st December. In that case, the grant will be provided in between. That means only for 6 months you will take to P&L. But the current liability will be for 12 months. Understand that. Do not do this mistake. So current liability will be what? Expected amount to be amortized within 12 months. For the next 12 months, what is the amount that will go to P&L? Non-current liability will be what? Total liability minus current liability. At the year end, you will have the total liability, no, minus the current liability. Same you do in IFRS 16 also, leases. Then coming to non-monetary government grant, this will not come for calculation, this will come for theory. So non-monetary government grant means what? When a government grant involves the transfer of non-monetary asset like land or any resource, like the government is only providing you an asset. The government is only providing you asset. The government is not giving you cash. In that case, what should we do? IAS 20 provides two options. The first one is what? Fair value approach. Fair value approach means if the government is giving you asset today, what is the fair value of that asset? So debit asset, credit deferred grant. This deferred grant, if I say today the asset I got a machine, the machine value is 10,000. I will normally depreciate this, and this machine, this 10,000 I will record as a deferred grant, and this 10,000 I will take into P&L based on the useful life or any other condition mentioned by the government. If I say that, sir, fair value is not available, if I say fair value is not available, then we use what? Nominal amount approach. In this case, used used when fair value of the asset cannot be reliably measured or the value of the asset is insignificant. Both grant and asset will be recorded at the nominal value. Example, 1, 2 or 3 rupees. I've not seen this, but MCQ is regarding fair value approach. So a question could come that saying that the grant is received by a government in the form of non-monetary asset, that is like land, some machinery. In that case, the asset will be recorded at the fair value and it will be recorded as a grant income and will be taken into P&L over the period as we get benefit. Then grant related to income. In this case, what will happen? Grant given by government to entity that provide support for expenses incurred by business rather than for acquiring specific asset. like staff training expenses, protecting the environment, doing welfare for the society, etc. A lot of things. In that case, if it's unconditional, what you do, directly take to P&L as an income. So debit bank or receivable, credit grant income in what other operating income. If I say it is conditional, conditional means what? Record it as a deferred income, and over the period take into P&L as the conditions are being fulfilled. See, in your P&L, what you can do, either you can record in the P&L as an income, or you can do what, or deduct from the related expense. If the government is saying that 10,000 is the salary you paid, 80% will pay, either 10,000 you record expense and then you record 8,000 income, or directly you can record 2,000 as an expense in net. This is allowed here. Then coming to the most important topic in IS 20, repayment of grants. That means the company have to repay this. So if the company have to repay, please see here now. Let me take an example so that it will be clear. Okay, let me here only. Repayment of government grant. When will there be repayment of grant? Repayment of grant will be when the conditions are not being fulfilled. So today what I mentioned, the government mentioned me that 4 years you have to use this asset. Now today what happened, the government came with a scheme saying that if any company is taking any asset and they are using for 4 years, and that should be in what, it should be in a green energy business, then only you'll get the grant. So today what happened, we received the grant for 10,000. So what we do, we normally record this into P&L. So divided by 4, 2,500 we record into P&L as income, grant income. Now what happened, 2 years done, 2 years are done. So for 2 years, how much is the income you have recorded? 5,000. What is the remaining balance? 5,000. Now after 2 years, the company has sold this asset. The company sold the asset. Now is the company fulfilling the condition? No. The government will get to know, the government will say that give us back the 10,000 which we have given you as a grant amount. So now see, whenever the company is paying back, what should the company do? If grant was recognized directly in P&L as an income, if it was directly recorded in P&L as an income, what we do? We will record it as an expense and we'll pay it. This will happen when in unconditional grant. If it's an unconditional grant, normally we do what? Debit, credit, we record in P&L income and we record bank. Unconditional grant, straightforward, today you receive the amount, you record income. Or if you have not yet received, in future, in the coming 1 or 2 months, you'll receive, you'll record the income today only. But the government says you have to refund. In that case, what you do? Debit, credit, in P&L you'll record an expense, and again credit bank. A simple treatment in what? Unconditional grant. But if it's a conditional grant and you're using deferred income, this one which I mentioned here, 2,500, 2,500, 5,000 we have recorded it as an income. So now this 5,000 is remaining, but the government is saying how much you should pay? You should pay full 10,000. Now when you pay full 10,000, can I say what will you do? Can I say credit bank of 10,000? Now what will you do? You will debit deferred grant, the balance which you had 5,000, because out of 10,000 only 5,000 we have recorded income. So that 5,000 is deferred government grant. We will remove that account, and the remaining will be how much, sir? 5,000. The 5,000 you will record it as an expense in the P&L. Under which category? Operating category only. So repayment of grant will be debited to deferred grant balance first. Whatever is the balance, can I say the balance was 5,000 here? Excuse me. And the remaining will be what? And the remaining will be debited to P&L. See, sometimes what can happen? No, the grant you receive is 10,000, but the government is saying that you only refund 8,000. In that case, what will happen? You are paying 8,000. The value of your value is how much? 5,000. Can I say then expense will be how much? Expense will only be 3,000. Expense will be 3,000. You have to see the amount and do the treatment. So then coming to the last one. What is the last one? The grant was recognized by reducing the cost of the asset. The grant was recognized as the grant was recognized by reducing the cost of the asset. Yeah. Let me take an example here now. See here now. Today the company has purchased an asset for 10,000. The company has received a grant of 2,000. So how much is the value they have recorded? 8,000. This is method 1 they are following. Method 2 was what? They record deferred grant and over the years they take into P&L. But in method 1 they reduce the value. So 8,000 is the value. I say the useful life year is 4 years. So how much is the depreciation the company record? 2,000. So 2,000 first year, 2,000 second year. Now the company it's for the company it's the end of the second year. So my carrying amount in the books will be how much? Carrying amount of the asset will be how much? 4,000. Now the conditions are not being fulfilled. The company is not fulfilling the condition of the grant. The government is saying that refund the grant. Now when you refund the grant, what do you do, sir? Debit what comes in, credit what goes out? Bank 2,000. Now what should we do? Now you should recalculate the value of the asset. What should you do? Recalculate the value of the asset if grant was not there, if government grant is not there. In that case what will happen? This 10,000 divided by 4,000, 4 year, 2,500, 2,500. So how much is the carrying amount of the asset? Can I say 5,000? If the grant is repaid, how much is the carrying amount of the asset? 5,000. But how much is the carrying amount they have recorded? 4,000. So what we do? We increase the value of the asset. We increase the value of the asset. Increase the value of the asset by 1,000. So that remaining 1,000, can I say, will be on debit side. This will be recorded into P&L as an expense. Why expense? The depreciation was how much? 5,000. But the depreciation you recorded is how much? 4,000. So the difference which you get here is what? The depreciation which you have recorded less. The amount of depreciation which you have recorded less is this value. So I hope everyone have understood this. Now see here now. Repayment of grant will be debited to the asset to increase the value of the asset if grant was not received and remaining debit to P&L to record the original depreciation. So debit asset, credit debit P&L and credit this. So I've taken an example here. Cost is 10,000, 2,000, 4 years. Same example we have done. So can I say here it is after 1 year. Here I've done for 2 years. So see here 10,000 minus 2, 8,000 for first year depreciation. Carrying amount 6,000. If grant was not there, what will be the carrying amount? So 7,500. So I increase the value of asset by 1,500 and the remaining will be recorded as an expense in the P&L. Understood everyone? Repayment, a very important topic from section A for MCQ. Chalo Semi. I hope to everyone this is clear. Now coming to some small topics. Forgivable loan. In this case, what will happen? Government, the loan from the government is treated as a government grant when the reasonable assurance that the entity will meet the terms for the forgiveness of the loan. That means if the government has given a loan today to you and the government is saying that you need not pay the amount back. In that case, can I say you are in benefit? You are in benefit. Now, this benefit, can you record it as an income? Yes. When there is reasonable assurance that the entity will meet the terms of the forgiveness of the loan. That means the company need not pay back. This will come for MCQ, not for calculation. Then if the loan is provided at a lower rate, if the company is providing the loan at a lower rate, then what should we do? If the company is providing the loan at lower rate, the company should record what? See now. Loan is recognized as per IFRS 9 financial instrument. As per financial instrument, the loan is recorded fair value. The difference between the loan amount received and the fair value of the loan is treated as a grant income. So today what? Today if you calculate the value of the loan, it is coming to 10,000. But the fair value of the loan, the amount which you have received from the government, let us take it is 8,000. So this 2,000 will be recorded as what? This 2,000 will be recorded as a grant income. Grant income. So the government grant will be accounted as per IAS 20, nature of government grant, purpose of the loan, amount received minus fair value of the loan as per IFRS 9 will be government grant. So you'll record debit bank, you receive how much? Debit bank, let's take you have received 10,000. The value of the loan is 8,000 and 2,000 is your government grant. Here we have taken ulta, no, sorry. Here we have taken ulta. So consider the amount which you receive from the government is 10,000. The value of the loan is 8,000 and 2,000 is what? The government grant. And this will be recorded into P&L. Over the loan term, record interest expense in P&L financing category. The normal loan treatment you will do as per IFRS 9, and the repayment will be treated, and this government grant will be recorded over the loan term. Over the loan term, this will be recorded as an income. I have not seen question from this, but what should you remember? One thing you remember, this is required. Amount received minus fair value of the loan will be government grant. Only remember this one line for a FR exam, because this is given on the ACCA study up. It's just written on one simple line. It can come in your MCQ question. I hope this is clear. Now disclosure, what are the disclosure? Accounting policy for government grant, including the method of presentation, must be disclosed in the notes to account. So what is the accounting policy? Whether they have reduced from the cost of the asset or whether they have recorded as a deferred income. And they have to mention the presentation method also, then what is the amount of grant, etc., xyz, everything should be disclosed. With this, your IAS 20 is also completed. So till now we have completed 5 important standards. Any doubts to anyone? I hope this session is going good. You're not feeling bored. I'm giving my 100% each and every point where you can make a mistake. I'm repeating it so that you avoid mistake in the exam. See, even though you'll say, sir, we know this, but even though if a MCQ question comes, you'll still do mistake. I've seen that with students. So that is the reason I'm repeating the points. Now, let us take a small break. Let us take a small break and come back and do the remaining IAS 36, IFRS 5, IAS 2, and IAS 41. So now the time is 8:11. Everyone be back by 8:21. Chalo. Everyone come back. I hope everyone are back. Yes or no in the chat box. I've shared the YouTube link. You can subscribe. The video will be uploaded by tomorrow morning. It will be uploaded on my YouTube channel also, your ACCA buddy, as well as Super Infinity. Chalo. Let us start. Let us not waste time. Time is very important. So till here, I hope to everyone this is clear. Now coming to important topic. IAS 36 and IFRS 5 very important. So little bit slowly I'll go here so that you understand each and everything. So IAS 36 impairment. So what does impairment mean, sir? Impairment means sudden decrease in the value of the asset. The value of the asset will suddenly decrease. So now impairment of asset will occur when the carrying amount of the asset is more when compared to its recoverable amount, that is RA. Carrying amount is more when compared to RA. Each and every time I'll say RA means recoverable amount. So why do we do impairment, sir? An important theory question that could come to ensure that the asset of an entity are carried at not more than the carrying the entity the assets of an entity are not carried at not more than their RA. So now impairment applies to all assets other than, see, impairment will not apply to inventory because IS 2 will take care. NRV, then deferred tax asset, contract asset as per your IFRS 15, then financial assets included in the scope of IFRS 9. In your FR, you do not have the impairment of financial instruments, it is in SBR. Then investment property measured at fair value. Investment property at fair value, that will be impairment will not apply because the fair value will already consider the impairment impact. After that, non-current asset classified as held for sale, IFRS 5. Once an asset is classified as held for sale, impairment will not apply. Then biological asset measured at fair value less cost to sell under IAS 41, because biological assets also at fair value, you will not apply what? Impairment. So now impairment is not done directly. You will never do impairment directly. For three assets, you will do impairment directly. Annual review, goodwill, intangible assets under development phase, intangible assets with indefinite life. But for other assets, impairment will not be done directly. At each reporting date, assess whether there are indications that an asset may be impaired. So at each reporting date, the company should see whether there are any indicators or not. If there are indicators, we do impairment test. If there are no indicators, no need for impairment test. Indicators are there, hints or indicators, impairment test. If impairment test is satisfied, asset is impaired. If impairment test is not satisfied, asset is not impaired. So now impairment test means what? Impairment test, you will do what? You will compare the carrying amount in RA. If the carrying amount is more than RA, yes, impairment. If the carrying amount is less when compared to RA, no need for impairment. Now what, sir, what is RA? RA is of two. RA is fair value less cost to sell or value in use. That means either the fair value less cost to sell will consider or value in use. Now whenever you have any asset, you can take the benefit in two form. Either you can sell the asset or either you can calculate the value in use. Value in use means you'll use in the business and you will discount the cash flows which you get. So either you can sell in the market and take the benefit, or either we can use in the business and make profits. So RA will be higher of these two things. Now, sir, what are the impairment indicators? Impairment indicators can be internal as well as external. So internal indicators are what, sir? Evidence of obsolescence of or damage to an asset. The economic performance, the asset has been damaged. The economic performance of the asset is reduced. It is not as same when compared to the previous year. Significant adverse change in the extent or the manner in which the asset is used. The way first we were using this asset for full time, now we are only using for 6 hours or 7 hours. That means the capacity of this asset has been reduced. So these are the internal indicators. External indicators, these are very important for your MCQ. External indicator, significant decline in the market value. The market value is declining. increase in interest rate. If the interest rate is increasing, the value in use will come down. We have seen this increase in interest rate, thus increasing the discount rate used in the value in use. Then market capitalization is lower when compared to the carrying amount. Whatever is the carrying amount in the books, if I say today the value of the today I say the value of my net asset in my book is 10,000, but in market my share capitalization is only 8,000. That means this is also a hint for impairment, because the shareholders or the stakeholders or in the market the participants are saying that the value of your company is less when compared to the asset which you have recorded. Why? There could be some impairment. Then significant changes in the technology, market, economy, or other factors, and it should have an adverse effect. If it has a positive impact, then it is not what? If it has a positive impact, it's not an indicator. If it has a negative impact, then we say it's an indicator for impairment. It should be adverse. Adverse means negative effect. Then annual impairment is required for what, sir? Annual impairment is compulsory for goodwill, intangible asset with indefinite life, and intangible asset and a development phase. Now, fair value less cost to sell. How will you calculate fair value less cost to sell? You will see any binding sale agreement. Have you done any agreement with some third party saying after 3 years or 4 years I'll sell this asset to you? Or current market price. In your exam, it will be given every time the fair value. Now, how do you calculate fair value? IFRS 13. Then fair value calculate fair value. How do you calculate? Market price minus transportation cost, then less cost of disposal. What are the other costs like transaction cost, commission, etc., brokerage, legal fees, etc. So active market is a market. We have seen what is active market, where the frequency is very high. Now cost of disposal will include what? Incremental cost. If you sell the asset, you will incur the cost. If not, no. So cost will include what? Legal cost, stamp duty, cost of removing the asset. It will not include finance cost and income tax. We have done a lot of MCQs regarding this topic also. What is the cost of disposal that will be included, excluded? It's important that, sir, finance cost will be excluded and income tax and finance cost will be excluded. Other things will be included. Costs that have already been recognized as a liability are not deducted in measuring fair value less cost to disposal. So, important point. It's regarding fair value calculation. This detail the examiner will not ask. Remember this point. This finance cost and income tax will not be included. Now, whenever termination benefits paid when laying off the employee, that means you close your business because of impairment, etc. The assets are not working properly. We shut down the business. You pay some benefit that will not be considered. Cost associated with reducing or reorganizing a business following the disposal of an asset. These all costs will not be included. These are liability. It will not be considered as a cost of disposal. Then, sir, we have discussed how to calculate fair and less cost to sell. Now we are discussing value in use. So, how do we calculate value in use? Value in use is entity specific, but fair value is market specific. Value in use means the future cash flow which we get, we discount it. So, value in use, this is again important for theory. We have seen a lot of theory questions. So, what are the cash flows that are included? Cash flows that are included are what? Projected cash inflows, including disposal proceeds. If you dispose of in the future the asset, that proceed also will get, as well as the income also you'll get. Then, sir, projected cash flows that are necessary incurred to generate cash flow. That means today you have an asset. To maintain this asset, some oiling is required, some maintenance is required. That also will be considered. How will you see this? Sir, 10,000 is my income every year. Sir, at the end of third year, I'll get 2,000 as an income. Sir, every year I'm incurring 1,000 to maintain this asset. Some oiling is required. Here and there some work is required. That will be also considered. You'll reduce it. Cash flow means what? Inflow minus outflow. You'll consider it. Then, sir, what are the cash flow that are excluded? Any future cash inflows or cash inflow or outflow expected to arise from a future restructuring. Now, the company is saying that in future, what we will do, we will further invest $500,000 or $10,000. We'll get further income. That all will not be included because the company has not yet committed. Just they are planning. We will not consider this. Exclude cost of finance as it is accounted for in discounting and taxation. You will not consider what? The financing cost also. Why? As it is accounted for in discounting and taxation, you will not include this finance cost. Now, so what is the discount rate you'll use? Discount rate should be pre-tax cost of capital. It should be what? Pre-tax cost of capital. It will include what? Time value of money and risk specific to the asset. You learn this in your FM and AFM to calculate this. But as of now, you should remember what? For FR, pre-tax cost of capital will be considered for discounting, and time value of money will be included, and risk specific to the asset. You have MCQs also on this topic. Now coming to future cash flow projection, a very important topic from MCQ point of view. Now the cash flow which the company is estimating, that should be what? Reasonable and supportable. It should be reasonable and supportable. It should be based on most recent budgets and forecast. Then it should be a maximum of 5 years. The cash flow which you consider should be for 5 years maximum. But sir, can we consider more than 5 years? Yes, we can consider if evidence is that okay, that you can get after 5 years also you will be getting the cash flow or not. Then then the cash flow also will increase. It's not that the cash flow will remain same 10,000 10,000, it will 10,000 11,000 12,000. So the increase in the cash flow should be at a steady rate. It should not be at a, you can't say 10,000 20,000 then 1 lakh then 10 lakh. No, no, that is wrong. Then the growth rate should not exceed the long term average. Whatever the growth rate you take should not exceed the long term average of the industry, the country, etc. XYZ. So the future cash flow, then, sir, cash flow estimate should include what? Future cash inflows, cost needed to keep the asset running, like your revenue expenditure. Cash flow estimate should exclude what? Cost to improve or upgrade the asset, capital expenditure will not consider. Cost from future plans not yet committed. Payments for existing liabilities. As I mentioned, liabilities termination benefit when you when you Hmm. When we say what in your IS 37 restructuring we do, we pay the employees, that will not be finance cost, and taxes will not be considered here. If there is no market based discount rate, if this discount rate which is not available in the market, then what should we do? The priority should be given to companies cost of capital. If that is also not available, then borrowing rate. If you go to the market, if you take a loan, what is the borrowing rate? And other market interest rate. So this is the priority. First to weighted average cost of capital, then borrowing rate, then other market interest. So we have seen an MCQ on this also. Remember the order. So now coming to the steps to solve the question for impairment. So what did I mention? What do you do normally? If you have a asset today, I say it is 10,000, it's 5 years. So 2,000 is the depreciation. What is the value here? 8,000. 2,000 again depreciation. How much is the value? 6,000. Now here you see that okay, your RA is how much? 4,000. So can I say, let me take a different number. I say your RA is 5,000. So how much is your impairment loss, sir? 1,000 is your impairment loss, but this 1,000 will be recorded in the P&L. Normally impairment loss will be recorded in P&L. Understand? If the asset, if the asset is under revaluation model, then you can offset it. CNO. Step 1, asset is impaired, carrying amount is more than RA. Impairment loss is what? Carrying amount minus RA you get. Then step 3, impairment loss is recognized in P&L generally. But however, if there is any balance in revaluation surplus relating to impaired asset, then impairment loss is firstly recognized in revaluation surplus up to any balance in it. I say that okay, our revaluation loss is 1,000, impairment loss. I say in revaluation surplus we have 500 surplus. So out of this 1,000, first you will reduce this 500. So you record debit, credit, debit, P&L expense. You record this as an expense, and this what we do out of this 1,000, what we do, this 1,500 we will offset revaluation surplus, and the remaining 500 will take to P&L. Remaining 500 will take to P&L. I hope everyone have understood this part. Then chalo, next one. Step 4 is what? Revised carrying amount. Once you charge the impairment, you get the new carrying amount. So carrying amount before impairment less impairment loss, you will get this as the revised carrying amount. This revised carrying amount will be used for calculation of depreciation in the coming years. In the future, what should we use? This revised carrying amount should be used for depreciation calculation. Avoid mistake in this. Whatever is the new revised carrying amount, that will be used for depreciation calculation. Understand that. So what is journal entry? If it's cost model, impairment loss, credit asset. If it's revaluation, we reduce the value of the asset. We'll take to revaluation surplus and then impairment loss of P&L. So the value of the asset is reducing by 1,000, 500 to revaluation and 500 to P&L. If the asset is measured at historic cost, then impairment loss is recognized. If it's a PP, under operating category. If it's investment property, investing category. If investment property is there and it is following fair value method, impairment will not be there. If investment property is following cost model, then investing category. If a PP is under revaluation model, then first offset with OCI to the extent that it reverses any revaluation surplus relating to the asset, and remaining will be taken to P&L under operating category. Any doubts to anyone in this impairment? I hope there is no doubts. The important point here is what you have to remember. See here now. Students will do mistake in this. If I say today I have machine 1, I have machine 2. For machine 1, I have a revaluation surplus of 10,000. For machine 2, I have a revaluation of 30,000 or 20,000. I say this machine 1 is impaired. This machine 1 is impaired and my impairment loss is 40,000. My impairment loss is 40,000. Now this 40,000, what will you do? This 40,000 is an impairment loss. So what will I say? My value of the asset is reducing by 40,000. Now what should I do? Out of this 40,000, how much can I record in OCI? Can anyone say me? How much can I record in OCI? Chalo, say me. Only 10,000. Only 10,000 I can offset. Do not say, sir, in revaluation gain we have 30,000. So 40,000 minus 30,000, only 10,000 will go to P&L. This is wrong. In your section B, question can come regarding when current asset when your PP, IS 30, IS 14 impairment is tested together. The for machine 1, if this is an impairment, and this should be offset with the revaluation surplus of that asset only. You can't use other assets revaluation surplus. So 10,000 you will offset it, and the remaining 30,000 you will take to P&L. In the regular class also I mentioned, we have done questions also regarding this topic. So please avoid mistake in this area. Even though after mentioning this in your mocks, in your past papers, again you're doing this mistake. So please avoid it. So now coming to cash generating unit. So what does cash generating unit means? Cash generating unit means a group of assets which generates independent cash flow. For me, my teaching setup is a cash generating unit. The iPad, the camera, the mic, etc. Everything is what? A cash generating unit. Because with this iPad pencil, can I generate any revenue? No. With the alone iPad, can I take the classes? No. I need my full setup, so that my setup becomes a cash generating unit. Sir, why do we form this cash generating unit? We form this cash generating unit because the impairment for a particular asset, to calculate the impairment for an individual asset, it is difficult. So why CGU? Sometimes array of individual asset cannot be determined because the asset cannot generate independent cash flow from which value in use is calculated. So impairment of asset will be done in CGU. So what is the definition of CGU? CGU is the smallest identifiable group of assets that generates cash flows that are largely independent of the cash flows from other assets. So that means it should be lowest aggregation. When you do the grouping of the assets, the group of the assets should be lowest as possible. If I have this pencil, iPad, then I'll include my monitor, my PC, all this. Until I get independent cash flow, I can include. After that, I should not consider. So the aim should be what? Lowest aggregation. So now asset can generate independent cash flow, yes sir. So test for impairment individually. If can't, then do the calculation for CGU. So now in impairment test, in case of CG, what are the steps? See, let me take an example. Step 1 is what? Calculate the carrying amount of CGU. Step 2 is what? Calculate the RA. It will be given in the question. Step 3 is what? Calculate the impairment loss by comparing step 1 and step 2. Then you do what? Then you allocate the impairment. First, you allocate the impairment to goodwill. If any asset is there which has been impaired, you will allocate to that. And then the remaining and then the remaining impairment loss will be allocated to the asset on pro rata basis on their carrying amount. Understand that? So impairment loss should not be allocated to those assets which are outside the scope, like cash, inventory, trade receivable. You will never charge impairment, because inventory, trade receivable, will the impairment will be taken care as per respective standards. And for cash, so I hope the concept of CG is also clear to everyone. I want to mention 2 or 3 important points here. Give me 1 minute. See here now, in this question which we have done, this is a question where goodwill is there, patent, machine, computer, building, etc. is that they have mentioned the RA is how much here? They have mentioned the RA is 1 point fair value less cost to sell is given and value in use is given. So we'll consider that and then we'll calculate the right to use. So my RA is how much? Fair value less cost to sell is 1200. Value in use is 1950. So my RA is 1950. So my impairment loss is 650. This impairment loss I have to allocate it. This impairment loss I have to allocate it. Now how will I allocate it? See here now everyone. Can I say an impairment review was conducted? Fair value. Half of the machines were completely destroyed, but the remaining machine can be sold for at least their carrying amount. They mention what here? Half of the machine were completely destroyed. That means what? Where is the machine? Out of 300, can I? Out of 300, can I say 150 is completely destroyed? Out of 300, 150 is completely destroyed. But can I say remaining 150 is there? On this remaining 150, should you charge impairment loss? Yes, you should normally charge impairment loss. But in the question, they mention what? The remaining machine can be sold for the carrying amount. If the remaining machine can be sold for the carrying amount, will there be an impairment? There will be no impairment. So you have to read the question carefully. If the question was silent, what we do on this 150 also we allocate impairment. But they mention that the machine can be sold. In that case, will not allocate. So see here now. So the first I allocated to goodwill. Then for patent, I because they mentioned that here the patent have become obsolete and are now worthless. So in that case, for patent we have allocated. Then for machine, can I say 150 is when the remaining 150 will be the same. Here impairment will not charge. So out of 650, we have charged 100, 200, and 150. So we have charged in total. If you see in total, we have charged the impairment of 350 or 100 to 300 for 450 we have charged. So the remaining is how much? 200. That 200 should be allocated for these two things, building and computers. For building and you will not allocate to this machine which is remaining 150, because in the question they have specified that it will be sold to the carrying amount. Avoid this mistake in this type of question. Now see here in this next question I have done here. In the next question, what we have done, in the next question only they mention this half of the machines are completely destroyed. They did not mention anything here whether the other half can be sold or not. So in that case the question is silent. What we'll do for the remaining buildings, that is what machine is 200. So out of 200, 100 is what? When? So the remaining 100, on this 100 also we should allocate impairment. We should allocate impairment. So see here now, I have charged impairment for 100, goodwill I have charged, patent I have charged, machine I have charged. Then what can I say? Remaining is the remaining 100. On that remaining 100 also I'll allocate impairment. So if I allocate the impairment on pro rata basis on the carrying amount, I'm getting 14. So we consider this and do the accounting treatment. I hope everyone have understood the CGU. The mistake where you'll make is this one which I mentioned to you. Then we have done. Now coming to the last topic of the standard, reversal. Very important. Many students will do mistake in this. Still don't know. Reversal of impairment loss. Goodwill once impaired. Can it be reversed? No. Whenever a question comes in the exam MCQ, can the goodwill impairment be reversed? Goodwill once impaired cannot be reversed. Other assets impairment loss can be reversed if indicators are positive. Whatever we have learned about the indicators for internal external, it will be ulta reverse. So for external, what we say, sir, market value is increasing, market capitalization is higher than the carrying amount, uh, market cap is expected to be higher than the carrying amount, then market rate of interest is decreasing, then favorable changes are there. In that case it was adverse changes. Then internal indicators, improvement in the asset is there, favorable changes in the use of the asset. See the calculation part now. Let me take an example so that you will understand this part. Many students have doubt in this reversal part, so please concentrate here. So see here now. Today I mentioned what? Everyone, I have a asset. The useful life of the asset is what? 5 years. So what is this? 2000 is my depreciation. So how much will be my carrying amount? 8000. Your hint or indicator is that your RA is how much? 6000. So hint or indicator is that RA is how much? 6000. So will there be impairment? Yes. How much is the impairment loss? Can I say 2000 is the impairment loss? This 2000 impairment loss is that. Now this 2000 impairment loss is that. This 2000, where will you record? This 2000 we will record in P&L. It's a cost model. I'm not doing regarding this one. After this, now can I say what is my revised carrying amount? Can I say my revised carrying amount will be what? 6000, 8000 minus 2000, the impairment. My revised carrying amount will be 6000. So the 6000 will be depreciated for 4 years. The 6000 will be depreciated. So the 6000 divided by 4 years, if I do, I get 1500 as a depreciation. So my carrying amount at the end of second year will be how much? So 6000 minus 1500, it's 4500. Now at the end of second year, there is a reversal. At the end of second year, there is a reversal. Now whenever reversal is there, what should you do? Reversal means the amount is going up. So now I say the RA is how much here? The RA is 7500. So now you only say the carrying amount is how much? 4500. Now it is 7500. Can you increase the value from 4500 to 7500? Yes, but there is a ceiling limit here. There is a ceiling limit. Now what is that ceiling limit? Understand here. How much was your carrying amount of 4,500? You had to travel to what? You had to travel to 7,500. But there is a ceiling limit here, bete. Ceiling limit. That ceiling limit is what? Carrying amount of the asset on the date of reversal. If there was no impairment in previous year, if impairment was not there in the previous year, what will be the carrying amount? So if the impairment was not there, can I say my carrying amount would have been 10,000 divided by 5? 2000 depreciation, my carrying amount would have been 6000. So my carrying amount is how much, sir? 6000. So this is the ceiling limit. So the RA is how much? The RA is 7500. But sir, there is a ceiling limit of 6000. So can you travel from 4500 to 7500? No. You will stop at what point? You will stop at 6000. So maximum reversal is how much? The maximum reversal you can do is what? The maximum reversal you can do is what? 1500, 4500 to 1000, 6000. It's 1500 is the maximum reversal you can do. You can't reverse 3000, only you can reverse 1500. So please understand this. I hope everyone have understood. Now the second case, in the second case I mentioned that the ceiling limit is coming to 6000, but your RA is 5500. That means you can do the full reversal here. You can do the full reversal. So you have to concentrate on the ceiling limit here now. So see here now, what is the formula you have to use? Reversal of impairment loss is restricted to lower of two things. That is what? Recoverable amount on the day of, on the date, on the date of reversal, on the date of reversal. Then sir, the carrying amount that would have been determined net of amortization depreciation if no impairment has taken place in earlier years. So you will calculate the recoverable amount. So I say the recoverable amount is 7,500, but the carrying amount is only coming to what? 6,000. In that case, you can maximum reversal can be till 6,000. So from 4,500 you can travel to 6,000. So but I say your carrying amount is how much? But I say you're carrying, your recoverable amount is 7,000, but this is 10,000. That means, can I say your carrying amount is 3,000? That means from 3,000 you can travel to 7,000. So you have to take this formula and consider the lower thing. Now reversal where we records are normally, see now, increased carrying amount cannot exceed a ceiling limit, which is carrying amount we mentioned. Note, a reversal of impairment loss is recognized in P&L unless the asset is carried under revaluation model. If the asset is under cost model, record the increase in P&L. If it is under revaluation model, then you will go to revaluation. You have to see what is the previous treatment done. Any revaluation, any reversal or impairment loss on a revalued asset is recognized to P&L to the extent that an impairment loss was recognized to P&L. First priority will be given to P&L. If you have recorded any expense in P&L first, record it. And any excess will go where any excess will be recorded to OCI. Any increase in recoverable amount of goodwill following the recognition of an impairment loss will likely be an increase in internally generated goodwill, which cannot be recognized as an asset. Important for your MCQ, true or false. Now, goodwill acquired in business combination and corporate assets cannot be tested for impairment individually. Yes or no? Goodwill will never generate independent cash flow. Your corporate asset means what? A headquarter. If Reliance is there, Reliance has four main business activities and they have a head office. And that head office is helping to generate revenue for Reliance, retail, oil, etc. In that case, that becomes a corporate asset. So impairment of goodwill and corporate asset will be done in CGU. So goodwill acquired in business combination, does not generate independent cash flow. Therefore, it is allocated to CGU that are expected to benefit from the synergies of business combination. So for goodwill and corporate asset, individual cash flows are not there. What we do, we record the impairment based on CGU concept. So with this, your IAS 36 also completed. Any doubts in IAS 36? I went slow and I've given 2 to 3 examples also so that you'll avoid mistakes. Okay, chalo then. Now coming to the IFRS 5. IFRS 5 non-current asset held for sale and discontinued operation. Now this standard was introduced because of what reason? That normally the company will do what? Normally the company will say that okay, we have an asset, we are classifying this held for sale, so we'll record this into current asset. So they normally used to, the ratios were affected, your quick ratio, current ratio were affected. So because of this reason, IFRS 5 was introduced. So what is the objective here? You learn the accounting for non-current asset held for sale. If any asset is there, you have classified this as held for sale. That means you will not use in your business. You will get the money by selling it. Disposal group or discontinued operation. IFRS 5 will not apply to deferred tax, financial asset, agriculture and biological asset, and asset arising from employee benefit. This is not there for you. Now, part A. First thing is what's a non-current asset held for sale. Then we'll come to discontinued operation. So, what is non-current asset held for sale? See now, definition. Non-current asset held or disposal group. Okay, non-current asset is an individual asset or it can be a disposal group. Will be classified as held for sale. Its carrying amount. If its carrying amount will be recovered through a sale transaction rather than continuing use. That means the company is saying that we will sell this, we will not use and get the money. The ultimate goal is that we will sell and get the money back. In disposal group is a group of assets to be disposed of collectively in a single transaction. That means a group of assets and liabilities, it will be disposed of in one transaction, and directly associated liabilities will be transferred in the transaction. Now, sir, classification of non-current asset, very important for theory. When will you say that, sir, we can classify an asset held for sale? If the asset is available immediately for sale, that means if any orders are pending, if the company is saying, okay, still 2 months, some two orders are pending, after that, we can sell the asset. After 2 months only, this will be classified as held for sale. Then sale must be highly probable. If you remember in the class, we had taken the example of Raju, etc., getting married, etc., XYZ. If you remember, good. If not, remember these 5 points. So management is committed to a plan to sell the asset. Yes. Active program to locate a buyer. The asset must be marketed at a reasonable price. The transaction is expected to be complete within 1 year from the date of classification. From the date of classification, significant changes or withdrawal from the plan is unlikely. That means the company will not change its intention. So the sale transaction is expected to complete within 1 year. That means what? See here now. Your 1st January 2000 X1, 31st 12 2000 X1. In this case, what should we do, sir? I say the company has classified the asset as held for sale on 1st July 2000 X1. Then what is the time period? They have the coming 12 months. It's not at this period. You will not consider this red color period. This is the right. That means the date when it was classified as held for sale, from the date 12 months. It's not a reporting date. It's the date when it has been classified as held for sale. Now see. So note, if an sale takes time due to customary practices, it's at the request of the customer or normally based on some market conditions, etc., then it will be considered as what? Okay, the sale is done today only. We can classify the asset as held for sale. If customer will take time for the payment or small repairs will be undertaken at customer request. That means today I'm selling my asset, but the customer is saying what? I will pay the payment after 2 months. Even though the payment is done after 2 months, I will classify my asset as held for sale today only. Or the customer is saying what? That do some small repairs and give etc xyz. In that case, today only I'll classify the asset as held for sale. Even though the repair will take 1 month, but that repair which I'm doing is at the request of the customer. So this is clear to everyone. Now, abandoned non-current asset. This can come in your MCQ. So abandoned non-current asset means what? Asset which is to be abandoned is not classified as held for sale. If an asset is abandoned, it will not be classified as held for sale until if the amount you recover from that asset is principally from the sale transaction. If you say that we will use this asset and get the money back, then it's not an asset classified for held for sale. Understand? However, a disposal group that is to be abandoned is treated as a discontinued operation when it is ceases to be used, as long as the definition of discontinued operation is being met. We will see what is discontinued operation. It can be what? Let's take, I have a factory. In my factory, I have a very old machine. This machine was purchased by my grandfather. So either I'm not selling, either I'm not using. In that case, will this be classified as held for sale? No, Baba. I say this belongs to my grandfather, so I need this, I want this. So I'm not planning to sell this. So in that case, it will not be classified as held for sale. It will be classified as an asset only under non-current asset. Measurement, initial measurement. Initially, at what value will record? Once you say that, sir, an asset is classified as held for sale, on initial day, what do you do? On the day of non-current asset classified as held for sale, it is measured at lower of two things. Its carrying amount. Carrying amount means after depreciation, revaluation, or impairment as per respective standard, and fair value less cost to sell as per IFRS 30. So if I say my carrying amount is today 1000, 10,000, and the fair less cost to sell is 8,000. So can I say this 2,000 is an impairment loss? This impairment loss is as per IFRS 5. It's not as per IAS 36. Understand? So if the fair value less cost of disposal is less than the carrying amount, the difference will be charged to P&L. Now in P&L, which category, sir? If the asset is PP or intangible asset, operating category. If the asset is an investment property, investing category. No depreciation amortization will be computed on such asset once an asset has been classified as held for sale. You can link this with IAS 16 and IAS 38. When will you stop depreciation amortization? Once the asset has been classified as held for sale. So now for disposal group, sir, disposal group means a group of assets and liability. How will you measure? Same. Carrying amount of the disposal group, fair value of the disposal group. If there is any impairment, how will you allocate impairment? Same like your CG, because in a group of assets, there are a lot of assets. So first to goodwill and then remaining to the other assets on the pro rata basis. I have not seen question regarding disposal group, but you can get for theory. What is a disposal group, etc. Impairment loss is recognized in P&L only, irrespective of whether the asset is under cost or revaluation model. Like your IS 36, where you used to take to P&L and revaluation, here you will not take. You will directly take to P&L. Either it is cost model, revaluation model. Even though you have a revaluation gain, you can't do anything. Directly it will be recorded to P&L. So then subsequent measurement, what should we do, sir? Subsequent, again, you should see at lower of carrying amount of fair value less cost to sell. Now what will happen? Today I purchased an asset. My carrying amount of the asset was how much? 10,000. The fair value less cost to sell was how much? 8,000. So what is this? This 2,000 I record into P&L as an impairment loss as per IFRS 5. Now will you charge depreciation? No depreciation. Now here what is my carrying amount? The carrying amount becomes 8,000. Again I'll see what is the fair value less cost to sell. I say 6,000. In that case, what we can do? This 2,000 you will record into P&L as an impairment loss under operating or investing category based on the asset. See here now. If fair value less cost to sell is lower than the impairment is lower, then impairment loss is recognized in P&L. If PP or intangible asset, operating category. If it's IP, investing category. If fair value less cost to sell is higher, if I say the fair value less cost to sell is higher, then difference amount is recognized as a reversal of impairment. Okay, sir, here also you can do reversal. Here also we can do reversal, but the reversal is limited here. See, now if I say this instead of 8,000, this fair value was now 10,000. The fair value was 9,000, I say. The fair value. Sir, normally we recorded lower of. Yes or no? Normally we should record 8,000. But sir, can we record at 9,000? Yes. See here. Maximum reversal of impairment loss can be up to the amount of impairment loss recognized earlier as per IS 36 and as per IFRS 5. So as per IS 5, can I say 1,000 is the 2,000 is the impairment loss recognized? So out of that only 1,000 I can reverse. So instead of showing at 8,000, I will show at 9,000 if reversal is there. This topic is not tested frequently in FR, but it can come as a tricky part in your exam. So remember, reversal can be done, but the reversal is limited to what? Maximum of the impairment loss as per IFRS 5 and as per IAS 36. And as per IAS 36 also, that should be in P&L. That should be what? In P&L, not in OCI. So, sir, presentation, how we will present? Non-current asset held for sale, how will you present, sir? You will show this under current asset as a separate heading. See, non-current asset, current asset, you will record as non-current asset held for sale as a separate line item. Disposal group, what we'll do? Sir, present assets and liability of disposal group separately. You will not offset it. You'll not say that, sir, in disposal group we have 10,000 asset and 2,000 liability. We'll record 8,000 as asset. No, record this under current asset. Record this under current liability. Do not record 8,000 under current asset. It's wrong. Asset and liability should be disclosed separately and should not be offset and present as a single amount. It should not be offset. Some important notes. See now. If an asset is classified as held for sale after the reporting period, then it shall not be considered as an adjustable event. Adjusting event. If you remember IAS 10, adjusting, non-adjusting. If an asset becomes, if the asset is classified as held for sale after the reporting date, then this is a non-adjusting event. It should be only disclosed. Non-current asset shall be classified as held for sale even if the current asset is not sold within 1 year. Yes or no? Now, sometimes what will happen? It's 1st January and it is 1st July. So you have to sell this within 30th June 2000x5. So, but what happened? The company is not able to sell this. Why the company is not able to sell? The company is not able to sell this because the reason is outside the control of the entity. The entity cannot control it. In that case, what we say, in that case, still the entity can show this as non-current asset held for sale. So the delay is due to those circumstances which are not in the control of the entity. The entity cannot control. That means they will still say that, okay, this is what, this is classified as held for sale. And there must be sufficient evidence that the entity is still committed to sell the asset. The entity is still committed to sell the asset. I hope there is no such doubt. This not required. We have already done above. Disclosure. What are the disclosures? The description of non-current asset. What is the non-current asset that has been classified as held for sale? How did you determine whether it has been classified as held for sale? What are the reasons? What are the facts of the case? What is the fair value gain or loss, etc.? You have to mention. So, any doubts in non-current asset held for sale? Anyone? I hope it is clear to everyone. This part. Then coming to the next part, discontinued operation, a very easy part. Discontinued operation means what? A discontinued operation is a component of an entity that either has been disposed of. Okay. Discontinued operation is a component. Component of an entity means which generates independent cash flow that has been disposed of or is classified as held for sale, and it represents a separate major line of business, or is a single coordinated plan to sell the asset, or is a subsidiary acquired exclusively with the view to resale. In your exam, if this topic comes, will come for theory. Discontinued operation means what? A component that has been either disposed of, either it has been disposed of, or it has been classified as held for sale. In that case, we say what, sir? And it should represent a major line of business or any geographical area, or we can say it is a subsidiary which is acquired with the view to resale. So now component of an entity means what, sir? And portion of the entity with operations and cash flow clearly distinguishable from remainder of the entity, both operational and for financial reporting purpose. That means the it's a part of the entity which generates independent cash flow. Now coming to presentation and disclosure. The presentation and disclosure. How will you present? This is the new format of your P&L. Revenue, cost of sale, gross profit. Then you have operating category, operating income. Then you have the expense, selling expense, research and development, general and administrative expenses, goodwill impairment loss, other operating expense. So you have your ultimate operating profit. Then under investing activities, you have share of profit or loss from associate and other investing income. You have this. Then profit before financing and income tax, you have this. So financing activity, you have to see that is finance income or finance cost. Then you have profit from tax. Then you have what? Income tax expense. Then you have this profit from continuing operation. After this profit from continuing operation, you record one line saying profit and loss from discontinued operation. Either it can be a loss, either it can be gain. Now the detailed calculation, where will you show? The detailed calculation will be shown in your notes to accounts. So entity should disclose following items in notes to accounts: revenue and expense of discontinued operation, pre-tax profit, what is the revenue expense, what is the profit before tax, what is the tax expense, what is the profit after tax, and what is the cash flow from the discontinued operation. So see an important note here. If an operation is classified as discontinued in the current year, then it must be classified as discontinued in the last year comparative. Yes or no? If this year we are saying that it is a discontinued operation, previous year financial statements which we provide should also say that okay, this is a discontinued, so that the comparison becomes like with like for the shareholders. If an asset is classified as held for sale in current year, then no need to classify it as in the comparative years. In held for sale, what we normally do in held for sale, we show under current asset. But is it compulsory to show that in the previous year also? No need. But for discontinued operation, it is compulsory to show. Now see, understand one thing. Whenever held for sale is there, if a non-current asset is there for held for sale, then what we do? We record it separately. Once it has been disposed of, will you record in current asset? No, you'll eliminate it. But when coming to discontinued operation, if the discontinued operation is classified as held for sale or it has been disposed of, it has been sold, still we do what? We still show this as a separate line item in your P&L. In P&L, we have show separate line item. Even though the discontinued operation has been disposed of, it has been sold, as well as it is classified as held for sale. If we say, okay, this has not been disposed in the current year, in the coming years it will be disposed, then what should we do? We should show separately in the P&L. So with this topic we have come. So when you include in your this profit and loss, can I say the profit and loss also will include what? Profit and loss on disposal. Profit and loss on disposal will also be included in this calculation. So with this, your part 1 is done. Part 1, we have completed the standards which are important for non-current asset part mostly. Now these two small standard will not take much time. It will take 15 minutes. We'll complete IS2 and IS41. Any doubt still here? Anyone? Ishika mentions clear, sir. Others? Okay. Now let me do inventory. Inventory and IS41. Give me. Yeah. Chalo. IS2, sir, inventory. What is inventory, sir? Now this IS2 inventory will not apply to financial instrument and biological asset, because biological assets related to agriculture activity and agriculture produce at the point of harvest. One, at the point of harvest, IS41. After that, IS2 will apply. We'll see. So this measurement provision will IS2 will not apply to inventories held by commodity broker traders. This can come in your uh, MCQ. That means what? Normally the measurement principles of IS2 will not apply on agriculture produce after harvest and minerals, a totally different standard. This will not come, but this can come in your exam. That means a commodity broker is there. For him, whenever he has that options or etc., that will be his inventory. In that case, we'll normally measure at fair value less cost to sell. Normally what we do, normally can I say inventory we record at lower of cost or NRV. But when a broker is there and that broker normally do what? Normally buy and sell the commodity. In that case, and it's not a commodity means in the market like forex market, futures, etc. Commodity market. In that case, they will use fair value less cost to sell. So what is an inventory, sir? Inventory is an asset that are held for resale in ordinary course of business. So okay, these are what? Held for sale in ordinary course of business like a finished goods, or are in production process, that is work in progress, or raw material which are used for the production of finished goods. So inventory will include finished goods, work in progress plus raw material. So measurement, initially you at what value will record? Initially we record the inventory at cost. Subsequent measurement will be at lower of cost or NRV. Now cost, I hope everyone knows cost is same like your IS 16. So cost includes three things: purchase price, conversion cost, and other cost. So purchase price, you will reduce import duties and taxes if it is non-refundable. Any other directly attributable cost like transportation, you will deduct trade discount. Will you consider cash discount? No. Will you consider carriage inward? Yes. You will not consider carriage outward. You will consider carriage inward. Then conversion cost, to convert the raw material into finished good, that also will be added, like direct production cost, production overhead. If you're manufacturing something, that means the rent of the factory, the electricity expense can be allocated to the cost of the inventory. On what level? On normal activity. You have seen that there are questions regarding this. On what basis? Normal activity level. That means if today I have a machine, normally in a month we can produce 1000 units, but actually would have produced 800 or 1200. That depends. That detailed calculation is not there in FR or SBR also. But what will you do? You will normally allocate based on the normal activity, that is 1000. Whenever there is joint product cost, deduct the NRV. Like joint product means what? Whenever we are manufacturing something, we get a byproduct, yes or no? Like when coming to Amul company will manufacture cheese butter, but they'll get buttermilk. That buttermilk, whatever is the NRV of that, you will reduce that amount, and then you will allocate the remaining amount to the cheese and butter on the standalone selling price. We have seen in the class. No calculation will not be there, you just have to remember. Other cost, what are the other costs? Are non-production overheads, only if incurred in bringing the inventory to the present location. Even though it's not related to production, it still can be part of the cost if it is what? Required to bring the inventory to the location. Like storage of whiskey, yes or no? If you store the whiskey, the older the whiskey, the higher the amount we get. So in that case, the storage cost or the warehouse rent expense will also be included. Borrowing cost, if the conditions are being met, we have discussed in IS 23. So these are the costs which are included. What are the costs that are excluded? Like your abnormal amount is excluded. Storage cost is also excluded unless it is required for the production process. If it's required, we'll include. Administrative overheads, selling cost, carriage outwards, we will not include. So the cost, the definition or the meaning of cost is clear to everyone. MCQ questions will come in your exam, so avoid silly mistake in this. The net realizable value, NRV. So for NRV we have three things. So NRV is basically means what? Estimated selling price. And NRV is what? Entity specific. NRV is your entity specific, understand, it's not market specific. Estimated selling price in ordinary course of business less estimated cost of completion and estimated cost necessary to make the sale. So NRV for finished good is normal. Estimated selling price minus cost to sell. Then NRV for work in progress is what? Estimated selling price less cost to sell, less cost to complete, because you have to complete the work in progress. So you include the cost to complete also. So, but the NRV for raw material has two different things. If the raw material which the company has, the company will convert this and sell as a finished goods, and this finished goods will be sold at a cost or higher than the cost at a profit, not at a loss. In that case, the cost and the NRV will remain same. In that case, the cost and NRV will remain same. If the goods are sold at a loss, that is below cost, in that case, measure raw material at lower of cost or replacement cost. Replacement cost means if you go today to the market and replace this raw material, what is the cost? So normally for raw materials, you have to keep in mind what if it is sold at cost or above cost, no issues. NRV and cost will remain same. But if it is sold at loss, then what? You will record the raw material at lower of cost or replacement cost. Replacement cost will be given in the question. So with the cost and NRV is also discussed. Now coming to some important points. Replacement cost is the amount that an entity would have to pay to replace an asset at the present time according to its current work, the current condition of that at the present time. So NRV is entity specific, fair value is market specific. If in the question, if both the data is given, fair value is also given, NRV is also given, then use what? NRV for your calculation purpose. Then coming to cost formula. In cost formula, this means what? Whenever the company has a large number of inventory, how will they calculate the value of inventory? So techniques of inventory valuation. In this case, inventory are not ordinarily interchangeable. That means we can't interchange the inventory. If I say today I have a phone and I have phone as a inventory and I have pen as a inventory, can we interchange these two? No, we can't interchange. In that case, what should we do? The cost of the phone should be taken and the cost of the pen should be taken. But if I say the inventory is ordinarily interchangeable, in that case, what? You have two methods: actual cost method and approximate cost method. Actual cost method we follow FIFO and weighted average cost. FIFO means what comes in first, that goes out first. Weighted average cost means on a weighted average basis we'll calculate the cost of the inventory. So it's very important that you avoid mistake in this, and you have MCQ regarding this inventory, IS2 inventory. Very good MCQs are there. Please solve it and avoid silly mistake in that. So FIFO means what's the first in, first out. Weighted average cost, you will take the full purchase during the year, you will calculate what is the average price, and you will multiply with the closing inventory. Now, ordinarily interchangeable means the company has 10,000 pens. Can I say they can be interchangeable? And the pens are of same company, same brand, same, everything is same. But approximate cost method, the other method is what? Adjusted selling price. Adjusted selling price means what? Normally the company will do what? They have a lot of inventory. they want to know the cost. They will normally have a margin based on each product. So they will just go to the Tally or any other software which they are using, they will deduct 25% or 20% based on the profit margin they usually keep. Then normally they'll get what the cost of that. Standard cost means as per your MA or PM which you have covered, the cost you have to take and consider. This will not be tested. What is important, you have to remember that what is FIFO and weighted average cost. FIFO means what? So first in first out, weighted average cost on the average price. We will do this. So let me show an example to you regarding these two things. See here now. In case of first in first out, can I say what we do here now? Sir, 200 inventory, purchase is 100, sold is 50, 40 sold, 150 purchase, 100 is sold, remaining is how much? 270. This 270 will be based on what value? This 270 will be based on the latest which are purchased. So now see here, I say that 200 are there, then we purchase 100, so 300, then we purchase 150, so 450 was in total, and then we sold 100 plus 40 plus 190 we have sold. So out of 450, 190 we have sold. So the remaining will be how much? The remaining is 270. This 270 will be based on what? 270. Out of this 270 you will consider 10. This 270 you will consider this 150, and this 270 you will consider this 100, and calculate your value. If still it is pending, then what will you do? Still it is pending, you will go this 200 you will use. This is FIFO. For weighted average cost, what we do? For weighted average cost, you will calculate the average price. You will take the purchases. See now, you take the purchases, you divide it by the total number of units, you will calculate a price. 20.13 is the average price. This average price you will multiply with 270. So 270 into 20.13, you get the closing inventory value. So I hope the FIFO and weighted average cost is clear to everyone. Then NRV, what are the reasons that the NRV? Because of increase in cost, the obsolescence of the product, a lot of reasons. So what is the important formula for cost of sales? Opening inventory plus goods purchase minus closing inventory is a formula which you have to remember. So recognition of an expense. Now recognition of expense means what? The value of the inventory is 100, but the NRV is 80. So that means there is a 20 rupees loss. This 20 rupees or $20 will be recorded in operating category. In operating category. So when the inventory is written down, recognize, write down as an expense in operating category. If the inventory has been sold, we record this as a cost of goods sold in the operating category. If when inventory is used in the construction of any asset, that means I say that my business is regarding cement. I use the cement to construct my office. In that case, such inventory is de-recognized at its carrying amount. That is cost of NRV and capitalized at past of the. It is capitalized as part of the cost of the asset, and that once the asset is ready, we normally depreciate and take into expense. So I hope the recognition of expense is also clear to everyone. What are the disclosure? The disclosure. What is the value of inventory? What is the loss you have recorded? What is the policy you have adopted? FIFO or weighted average cost. LIFO is not there. LIFO has been removed. It's not there in IAS and IFRS. Understand that. So with this, your IAS 2 inventory is also done. Revision. Coming to the last standard for today, IAS 41. That is what? Agriculture. So now IAS 41 agriculture, very important for MCQ. As mentioned, your part 3 is very important for MCQ. So now IAS 41 agriculture scope. What will you cover in the standard? You will cover the accounting treatment for what? Biological asset. So biological asset means what's a living plant and a living animal. Agriculture produce at the point of harvest. Once there is agriculture produce, how will you cover? And government grant. Government grant. If you remember IS 20 government grant did not cover the government grant related to agriculture, but that government grant is covered under IS 41. So IS 41 will not be applicable to land related to agriculture activity. If there is a land which you are using, IAS 16 will apply. Intangible asset IAS 38. If you have a bearer plant, what is bearer plant will come. Bearer plant is IAS 16. Government grant related to bearer plant will also not be covered. If bearer plant is as per IAS 16, the government grant relating to bearer plant also will be IAS 20, not IAS 41. Other fixed asset like agriculture activities used in agriculture activities like tractors, equipments, everything will be, this all will be treated as per IAS 16. Now coming to the definition. What does agriculture activity means? Agriculture activity means it's a management by an entity of the biological transformation and harvest of biological asset. The company will manage for what reason? For biological transformation, for the growth of the plant, for the growth of animals, and harvest. They will harvest from that. Either they'll take fruits, milk, wool, or etc. For what? Why are they doing this? For sale purpose. Either they'll sell the agriculture produce or conversion into an agriculture produce. Either they'll sell the biological asset only. What? They'll say that we'll grow the biological asset and we'll sell it, or they will take out the produce and sell it. Sale or conversion into agriculture produce or conversion into additional biological asset. They maintain this for converting or multiplying the biological asset so that they can sell and make money. Now, what is biological transformation, sir? Biological transformation means growth, degeneration, production, procreation that causes qualitative or quantitative changes in biological asset. Either qualitative changes there or quantitative changes there. Harvest means what, sir? Harvest means the detach of the produce from the biological asset or cessation of biological asset life process. Either the biological asset life is at an end, like whenever we cut the crops, life is end, or in case of your uh, what we say hen, etc., sheep, the flesh which they have carcass, this will be what? Detachment. So what is the biological asset? Biological asset is a living animal or a living plant. Living plant will cover what? Crops and wood. And living animal will be what? Like cows held in a dairy farm, sheep and goat poultry farm. So crop like cotton plant, sugar cane plant, wheat and rice. Woods like your teak wood tree, pine wood tree, because this teak wood and pine wood tree will not give you any agriculture produce. What will the company do? They will grow this. After 20 years or 50 years they sell this as a log. So this will. Now barrel plant. What is barrel plant? Barrel plant is also a living plant like your mango plant. Can I say whenever you have a mango acre, the aim is what? To sell the mango. The aim is not to sell what? Mango tree. So barrel plant is a living plant used in production or supply of agriculture produce. Can I say this mango tree is giving me agriculture produce? So for mango tree, you'll say what, sir? It is IAS 16. On this, if mango is there, you say IAS 41. If mango you are plugged and it is below, so in this case, what we say, this mango will become what? IAS 2 inventory. So see you now. Used in production, expected to bear produce for more than one period. That means the produce which you're getting from this is more than 1 year, like your rubber tree, fruits, etc. Has a remote likelihood of being sold as agriculture produce. That means the tree will not be sold here. The chances are very less that the tree will be sold as a biological asset, except for scrap sales. That means any, like if this mango tree is there, leaves will be there. That leaves we can sell at a scrap and we can get some amount. In this case, this will be a barrel plant. So now example mango tree, rubber tree. Now an example I've taken few example where IS 41 will apply. Now if a company is that the company has a dog for security purpose, IS 41 will not apply because they are not doing the management of any biological transformation. If a circus is that the circus has animals, will those animals be treated as per IS 41? No. Then IS 16 will apply. IS 16 will apply. Understand? If you're doing fishing, if you're doing fishing in a lake, will this be a biological activity? No, Baba. If you're doing aquaculture, fish farming, you're doing, then it will be IS 41. Now, recognition, sir. Now, sir, biological asset or agriculture produce, how should we record? Your biological asset or agriculture produce should be recorded when? When entity controls the asset as a result of past event, control should be there, future economic benefit should be there, and cost should be known. Till now, the standards which we have covered, we have seen cost should be measured reliably. But here, fair value also should be measured reliably. Either fair value or cost. This is the one standard where you learn that, sir, in case of recognition, we consider fair value also or cost. So, recognition when, sir, entity controls future economic benefits, fair value should be available. Measurement, biological assets. Initial measurement, initially at what value it is recorded. Initially, biological assets are recorded fair value less cost to sell. If there is no fair value, then cost model can be used. If cost model is used, you will follow the cost model same as per IS 16. Accumulated depreciation, accumulated impairment. If you remember impairment, we have done that. We have seen impairment will not apply if it is at fair value model. If it has cost, we will apply. So what is the journal entry? Journal entry: debit biological asset, credit bank. On initial day only you will have a gain or loss. Why? Because when you purchase it, when we purchase, we pay some amount. The purchase price will be what? Entry price. Purchase price will be what? Entry price. But when you recorded fair value, your fair value is exit price. So there will be some of the difference, 100, 200 rupees, that will be recorded as a gain or loss. This gain or loss, where it will be recorded? This gain or loss will be recorded in investing operating category on initial record. Subsequently, at what value, sir? Subsequently, you will record at what? Fair or less cost to sell. So today I say that I purchase the I purchase an animal for 700. Now in the market, the fair value less cost to sell is 690. That means 10 rupees today only I have a loss. I paid 700, but the fair value is 690. Then this is at the starting date. At the year end, what we do? This 690 is your then again you'll calculate the fair less cost to sell. If I say the fair less cost to sell is 650, again I have a 40 rupees loss. This will be recorded into operating category. So journal entry: if there is a gain, debit biological asset, credit remeasurement gain, P&L. If it's a loss, what we do? In P&L we record it as a loss and credit biological asset. So note, once biological asset is measured at fair or less cost to sell, then it should be measured at fair or less cost to sell. No option for cost model. Once we follow fair or less cost to sell, we can't shift to cost model. Fair or less cost to sell of a biological asset can change due to both physical change and price change. In the class we have done question regarding this, but in your exam it will not be tested. But you have to remember what? The value of the biological asset can change because of two reasons. One is what? Physical change and price change. I will do one example. If a new calf is born, that means a calf is born. In that case, did the company incur any expenditure? No. So the company will record this as a biological asset and credit what? As a gain in the P&L. But a question comes saying that, sir, we feed the cow, a lot of medical expense will be there, etc. During a lot of expense. In that case, what will? That all expense will be taken to P&L under operating category. You will not capitalize, you will not do anything here, directly to P&L. So whatever cost you have incurred, like feeding the animals, any medical treatment, etc., whatever cost will go to P&L as an expense. But when a new calf is born, directly you record as a biological asset and you record it as a gain. This was the accounting treatment for biological asset. Now coming to agriculture produce. For agriculture produce, what? Agriculture produce is the harvested produce of the entity's biological asset. That means whatever you produce. Now, if this is a mango tree, once you have the mango, you'll treat this as per IAS 41. Now, once it is plucked, after that IAS 2 will apply. IAS 2 will apply. Once you pluck the mango, after that we apply what? After that we apply IAS 2 inventory. Now, sir, agriculture produce will be recorded at what value? Your agriculture produce initial measurement. Your agriculture produce also will be recorded as fair or less cost to sell only. Any gain or loss on initial recognition will go to operating category. In your in your agriculture produce, the full amount will be gain only. See now, debit agriculture produce and credit gain. The mango which is there on the tree which you're getting is agriculture produce. So what you do today? Agriculture produce, and in P&L you record as a gain. 100 rupees, 100 rupees, that is the value of the mango. Now what will you do? Once you plug this, what you do? You apply IAS 2. Now after this IAS 2 will apply. So now you shift this agriculture produce to inventory. So what will I do? I'll credit agriculture produce account. I will debit inventory account. 100, 100. Now this is initially recorded. So the cost will become what? Initially it is recorded cost. Can I say this cost is what? The fair value as per IAS 41. So in future, what will you do? You will compare this lower of cost or NRV. In that case, the cost is what? The cost is the fair value as per IAS 41. So see here now. After agriculture produce has been harvested, IAS 41 ceases to apply. Agriculture produce becomes an item of inventory. Subsequent measurement, treat it as per IAS 2 at end of reporting date. Fair or less cost to sell at point of harvest is taken as a cost for the purpose of IAS 2 inventory calculation. The cost was here what? The fair value of 100. So with this, we have completed the accounting for agriculture produce. Same. At subsequent also, you will do at fair value only. Subsequent also, it will be done at fair value. Now coming to government grant. In government grant, there are two things. If the biological asset is at fair value model, fair value less cost to sell, or the biological asset is at cost model. If the biological asset is at cost model, then we follow what? Same accounting treatment which we have covered in IS 20. Method 1, method 2. Method 1, what? Reduce the government grant from the cost of the asset. The second method is what? Record it as a deferred income and take into P&L. But if the biological asset is recorded at fair value, then if it's an unconditional grant, directly record into P&L as an income, no issues. If it's a conditional grant, important, the difference is here only. If it's a conditional grant, the entity recognize it as an expense only when the conditions have been met. That means normally in IS 20, what we do, if the condition is 3 years, for 3 years we record the income. But here in IS 41, after 3 years only you can record the income. After the third year, after 3 years are completed, then only we can record the income. Before that we can't record. In IS 20 we can record each year, but here you can't. Once the conditions are being met, you will record it as a straightforward income in your book. So with this, the government grant for IS 41R is clear, I hope. Disclosure. What are the disclosures, sir? Separate disclosure of physical change and price change should be mentioned in the notes to account. The method and assumption used in determining the fair value. What was the assumption when you determine the fair value as per IFRS 13? A reconciliation should be given. You have to provide a like a passbook. You have to make a reconciliation statement for agriculture. How many assets came in, how many assets were disposed of, etc. The aggregated gain or loss arising during the period. What is the aggregated loss or gain? What is the amount? So here the difference will be recorded in P&L. It will not be recorded in OCA. Everything will go to P&L here. So with this, we have completed the revision of IS 2 and IS 14. So with this, today's session is done. So with this, we have completed the day 1 revision of IS 16, IS 38, IS 40, IS 20, IS 23, IS 36, IFRS 5, IS 2 and IS 41. 8 standards we have covered today. So with this, I hope you have understood and this session was helpful for you. The coming 2 days will also be more helpful as these standards are small. The other 2 days, the standards which we'll be doing are very important. Okay. Chalo then. Okay. My agenda is not to do questions here. My agenda is to revise the standards and to mention the mistakes which you'll make in the exam. And the revision will be a little bit fast only. It's not that I'll go slow. If I go slow, that means that revision will be for 15 hours, 20 hours. We do not have that much time. So we'll do it fast. As you've already done with your mocks, your preparation, etc. You know the standard. So it's just a revision so that it hits here that, okay, these are the mistakes I have to avoid in the exam. So with this, can we end the session now? Bye bye. Have a good day. Good night. Signing off. Radhe Radhe to everyone.